Okay, good morning everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagodia. Now, if there is no issue with the sound, so that we can start, please do let me know. Either comment saying yes or give me a thumbs up or alphabet yes, yes, anything is okay. Please do let me know. Okay, thanks a lot. Let's start. So yesterday what we have done? Yesterday we started with a new chapter, the concept of fiscal policy taxation. Right, in fiscal policy again there are many more concepts. Budgeting you have to understand, the subsidy policy you'll have to understand, right? There are many other concepts. So yesterday we have started with idea of a taxation. Now what are the things that we have discussed? First one, what is the meaning of a tax? What is the meaning of a tax? Tax is a charge. It's a levy that is imposed by the government on the taxpayers, such as you and me, such as the companies, such as investors, etc. The term is called as a tax. Now, why does government impose a tax? Government requires huge amount of money for achieving certain expenditures, right? For making certain expenses. Either it could be for providing subsidies, construction of infrastructure, right, repayment of the loans, etc. For many purposes, government will use the tax money. And one more reason why generally government imposes the tax is to provide a lot of public goods. Lot of public goods. Please remember this term. In case of public goods, right, a lot of these public goods which are provided by the government, it's free of a cost. Right, all of you will agree with me? These particular public goods which are provided mainly by the government, these are free of a cost, right? That is, you and me, we will consume these public goods, but we do not pay for it. We do not particularly pay for it. The term that is generally associated with this concept is called as a free rider problem. We have not discussed this terminology, but please remember this. There is something called as a free rider problem. What do you mean by free rider problem? Right, understand this example. Imagine in front of my home, a road is constructed. A street light is installed. I don't pay money for it. I don't pay money for it. Right, but I will start using these services. It's a public good. I'll start using it. Right, so even though I'm using it, I do not pay money. That is a concept of free rider. Free rider. I'm using it, but I'm not paying. So public goods are generally associated with the problem of free rider. Now, how do you address it? Government cannot print money, right? Because if government will keep on printing money, that will cause inflation in the market. So how does government address the issue of free rider problem to provide public goods? They will impose taxes. They simply impose taxes, right? So that is another reason why taxes are imposed by the government. Third reason why taxes are imposed, generally government wants to address income inequality. Government wants to address the issue of income inequality, right? Certain people are earning huge amount of money, large people are not earning any amount of money, so huge income inequality is there. So people who are earning more money, government will impose more taxes, collect more taxes, so that the income inequality will come down. So these are some of the reasons why taxes are imposed by the government. Then the different types of taxation systems, different types. One is direct taxes, indirect taxes. Direct taxes, right, basically it is imposed on income, assets, etc., whereas indirect taxes are imposed on transactions. Whenever the sale will happen, indirect taxes are applicable. Example of direct taxes, right, the government has imposed different types of direct taxes, such as property taxes, income taxes on companies, income taxes on individuals, etc. And indirect taxes, where the tax burden can be transferred, these are called as indirect taxes. Best example is a GST, goods and services tax. Then we have discussed progressive, regressive, and proportional taxation. Progressive simply means whenever the tax base will increase, the amount of taxes that you're going to pay out of this will keep on increasing. That is called as progressive. Regressive means the tax base will increase for you, but out of that, how many or how much percentage you will pay in the form of taxes, it will keep on decreasing. That is called as regressive. And proportional, what is the tax base does not matter. What is the tax base does not matter, right? You will keep on paying certain fixed percentage out of it in the form of taxes to government. That is called as proportional. Then we have discussed ad valorem and specific taxes. Ad valorem taxes are those taxes which are imposed based on the value of the product. Based on value of the product, ad valorem. On the value of the product, taxes are imposed. Whereas in the context of specific taxes, the taxes are imposed based on physical attributes of the product. For example, length of the car, length of the cigarette, volume of petrol, right? These are specific types of taxes. Then we have discussed surcharge and cesses. In surcharge, a tax is imposed, right? In addition to existing taxes, whenever the income will cross a certain threshold, that is called as surcharge. And what it says, a tax that is imposed and collected by the government to achieve a specific objective is called as cess, right? So apart from this, we have discussed countervailing duties. What is the concept of countervailing duties? The taxes are imposed and collected in order to offset, in order to negate the subsidies that are enjoyed by the exporters, right? That is countervailing. Anti-dumping, certain exporters suppress the prices and export more into India. In order to eliminate this dumping activity, government will impose additional taxes, which is called as anti-dumping duty. And the third one is a safeguard duty. Safeguard duty generally is imposed in order to safeguard, protect, and promote domestic manufacturing because of sudden rise in the imports. Whenever there's a sudden rise in the imports, these are competitive. Domestic companies will not be able to compete with these, right? And that will affect their manufacturing activity. In order to protect the domestic companies, the safeguard duties are imposed by the government. So these are the different types of taxation system that we have discussed yesterday. Then we were discussing income taxes. What are the points? Income taxes are imposed under the powers given to Government of India under the Income Tax Act of 1961. Income Tax Act of 1961. Under the Income Tax Act of 1961, undivided families, right, individuals, salaried personnel, or even companies, etc., all of them are covered under this, and these are taxed, right? So we have discussed individual income taxes, that is income taxes that is paid by you and me. We are individuals, right? That is called as a individual income tax. What about corporate taxes? We are supposed to start from here. Let me start now. What about corporate taxes? In India, please remember this. Whenever the companies, corporates are nothing but companies. Whenever companies will earn profits, whenever the companies will earn profits, part of the profits are collected away by Government of India in the form of corporate taxes. Now, what is the rate of corporate taxes? Please understand this very carefully. Do you remember the term deductions? Please do let me know. Yesterday, we used a term while discussing taxable salary, etc., etc. We used the term deductions. Please do let me know. All of you remember the term deduction? In fact, there are three terminologies. One is called as a deduction. Second one is called as exemption. Third one is basically called as a rebate. First one is a deduction. Second one is exemption. Third one is called as a rebate. What is a deduction? Deduction simply means whenever you have incurred certain expenses. Whenever you have incurred certain expenses up to certain limit, these expenses will not be attracting taxes. I'll repeat the statement. Whenever you are incurring expenses up to certain limit, these expenses will not be taxable. Right? And now some of you will have this kind of a doubt, and many of you will ask me, sir, what do you mean by this? Let me give a very simple example. Imagine you are having 2 lakh rupee, right? Or not 2 lakh rupees, let's say 5 lakh rupee income. Imagine your income is 5 lakh rupee. Okay? Imagine your income is 5 lakh. Salary is 5 lakh rupees. The government will not impose taxes on 5 lakh rupees and collected taxes. No, government will not do that. What government says is, out of 5 lakh rupees, if you contribute, there is a section called as section 80C. There's a section under the Income Tax Act, right? Section 80C. And government says under section 80C, if you incur expenses up to let's say 1.5 lakh rupees, if you incur expenses up to 1.5 lakh rupees, these expenses will not attract any income taxes. All of you okay with this? Right? These incomes, I'm sorry, these expenses, right? Because they are part of the income. You are taking money out of your income and spending money. All of you okay with this? Right? So these expenses will not be attracting any amount of income tax. Let's say hypothetically, you will take 1.5 lakh rupees and invest in the public provident fund, PPF, public provident fund. So 1.5 lakh rupees, 1.5 lakh rupees out of this, where you have invested in the PPF, government will not impose income tax on it. So out of 5 lakh, I will deduct to 1.5 and I'll be left with 3.5 lakh rupees. This is a taxable salary. This is a taxable salary. Anybody has a problem with this? So government will now impose the taxes on the taxable salary and they will collect taxes from you. Second, what is exemption? What is the concept of exemption? This is again income, but this income will not attract any income tax. No threshold, nothing. This income will not attract any amount of income tax. For example, imagine you have earned 5 lakh rupees salary. In this year, your income is 5 lakh rupees, but this is from agriculture sector. This is from agriculture sector. And if you ask me, sir, why agriculture sector is considered here? In India, if you earn any income through agriculture sector, right, you will not be taxed income tax on this. Any amount of income that you earn from agriculture sector, that is, imagine you're a farmer, you have earned 5 lakh rupees income from the agriculture sector, that 5 lakh rupees is completely exempted. That 5 lakh rupees will not even be considered, right, to impose income taxes. So on this full 5 lakh rupees, government will collect 0 rupee income tax from you. 0 rupee. Complete income is exempted. Third one is a rebate. Third terminology is called as rebate. Let's say hypothetically you have paid 30,000 rupee in the form of income taxes. Hypothetically you have paid 30,000 rupees in the form of income taxes, but you were actually supposed to pay only 27,000 rupees. Right? You are supposed to pay only 27, but you have paid 30,000 rupee taxes to government, income taxes, of course. So government will say, whatever is the payment that you have done is more than your tax liability. Is it okay? Whatever payment you have done is more than your tax liability. Hence, I will rebate 3,000 rupees. I will return 3,000 rupees to you back. Right? So these are the three terminologies: deductions, exemptions, and rebates. Please remember these terminologies. Now, let me start. In the context of corporate taxes. In the context of corporate taxes, Government of India has a different rates applicable on corporate taxes. Right? There are, right, different rates of corporate taxes applicable. One rate is 30%. One rate applicable is 30%. Government says you pay corporate taxes at 30%, you can claim deductions. Right? You can claim deductions. Okay, you pay 30%, you claim deductions. That is first rate. Second rate, there is also one more rate which is applicable now, 22%. Right? There's also one more rate, 22%. Government says out of your profits, you can pay 22% to the government, but you cannot claim any deductions. You'll not be allowed to claim any deductions whatsoever. And there is one more rate for the companies which will start manufacturing in this financial year, where corporate tax rate applicable is 15%. Is it okay? I'll repeat it again. Listen carefully. One rate is 30%. Whatever is your profit, out of that 30% you pay, but you can claim deductions. Second rate is 22%. You do not want to claim any deductions. then whatever is your profit, out of that 22% you give it to government. And the third one is new companies which will start manufacturing in this financial year. Government has a special corporate tax rate for them, 15%, 15%. But it is applicable to the companies which are manufacturing, starting manufacturing in this year. So these are the three different rates. Now, there is a discussion which is happening. Earlier, only one rate was applicable, that is 30%. Right? Earlier, only one rate was there, 30%. And in somewhere at the end of 2019, Government of India introduced a new regime where 22% tax rate was actually introduced. So earlier only one rate, 30%. Now again one more rate was introduced, 22%. Now why did the government do it? What are the problems with this, etc., etc.? Understand this now. Let's start. Understand. We'll do a critical evaluation. Government earlier had only one rate, 30%. It was reduced to 22%. Some of the companies can pay taxes at 22%. Why did government do it? What was the objective? But what is the problem related to that? I'm doing a critical evaluation here. First one, what are the benefits? If you reduce the corporate tax rate, from 30% to 22%, you will be able to attract a lot of investments in India. You will be able to attract a lot of investments because the reason being, companies want to pay lower rate of taxation. They want to pay very low amount of taxes. So when the tax rate was reduced from 30% to 22%, the objective was we will be able to attract more and more investment in India. First point. Second point, it's just not India. Many other countries already had reduced corporate taxes. For example, USA, United States of America, when the president was Mr. Donald Trump, when he was the president, they reduced their corporate tax rate from 35% to 21%. They reduced their corporate taxes. And many other countries also reduced their corporate taxes. But in India, we still had a corporate tax rate of 30%. Now we reduced it from 30% to 22% because many other countries were doing it. And many companies in India were demanding, saying that other countries are doing, why you are not doing it? So that is the second reason. Third reason, whenever, please understand this. Whenever you expect more and more investment, in the economy, can we say it will lead to a virtuous cycle of growth in the economy? Let me see. Whenever you expect more and more investments in the economy, can it lead to a virtuous cycle of growth in the economy? Of course, yes. So government wanted to promote a virtuous cycle of growth, more investments, more employment, more production, more supply, etc. And the fourth benefit that we're expecting from this kind of a policy is it will promote ease of doing business in India. It will promote ease of doing business in India. Now, many of you ask me, sir, what do you mean by ease of doing business? In simple way, any policy of the government which will promote more manufacturing, which will promote more investments, these are generally referred to as ease of doing business reforms. For example, please tell me, I'll give a very simple example. You'll have to answer to me now. If you want to invest in India, would you prefer a corporate tax rate of 30% or 22%? Question number one. You want to invest in India, would you prefer a corporate tax rate of 30% or 22%? Right? You should prefer 22%. Okay, because lower tax rate. Second example. Imagine, I'll give you two examples. Imagine there is one example wherein you want to get 10 licenses. But to get the 10 licenses, you'll have to go to 10 departments or 10 ministries. You want to get 10 licenses. To get those, you'll have to go to 10 ministries. Second example, you want to get 10 licenses. You don't have to go to 10 ministries. You can go to only one website, apply for the licenses. And all the 10 licenses will be given through the portal or website. Now, please tell me, as an investor, would you prefer example 1 or example 2? Think of it. Would you prefer example 1 or example 2? Of course, you should prefer example 2. I'll give you one more example. Imagine you are investing in India, you are manufacturing a product. Now, on the product, would you prefer paying multiple taxes at the state government level plus a central government level, or would you prefer paying only one tax, that is a GST? Please think of it, right? Because after some time we are going to discuss a GST. Don't ask me, sir, why GST will promote ease of doing business. Again, I'll repeat the question. You are a manufacturer. You are producing, right, a product. You are manufacturing a product. You want to sell it. Would you want to pay multiple taxes on the product to the state government as well as central government, or you want to pay only one tax, which is called as GST? You should prefer only one tax, which is GST, because it is easier. It is easier. Having to pay one tax is easier compared to paying multiple taxes to central government, state government, and from one state to another state, the taxes will keep on varying. So rather than having multiple taxation, it is better to have only one tax. So now tell me, looking at all the three examples, 1, 2, and 3, can I say this will promote ease of doing business? All of you okay? This will promote ease of doing business. Anybody has a problem? All the three examples are there in the current affairs, right? So this will promote ease of doing business. So the objectives or the benefits that the government of India expected by reducing corporate tax rate from 30 to 22% are these. Now, having said so, what are the concerns? What are the issues related to such a policy? Point number 1, whenever government will reduce the tax rate, can I say the tax revenue of the government will automatically come down? All of you okay with this? Whenever the government will reduce the tax rate, the tax revenue collected by the government will automatically come down, right? And that's what actually has happened here. Government of India, by reducing the taxes from 30 to 22%, has had to lose certain amount of tax revenues. In fact, this Friday I'll give you articles related to this. Please read. More than 1 lakh crore rupees, tax revenue has been lost by the government because they have reduced the corporate tax rate from 30% to 22%. That is point number 1. Point number 2, right? Think of it. Point number 2, the investments, if they want to invest in India, if companies want to invest in India, tax rate is important, but only tax rate will not attract investments. I'll repeat the statement. If there is any doubt, please do let me know. If you want to attract investments in India, tax rate is important, no doubt, but only reducing tax rate will not attract investments in India. Now you'll ask me, sir, what do you mean by that? What if I say you want to invest in India looking at the tax rate, but skilled labor is not available? Skilled labor is not available in India. Would you prefer to invest in India or China or Taiwan for that matter? Think of it. You want to invest in India, corporate tax rate has come down, but it is not easy to acquire land in India. It is not easy to acquire land in India, and that's a fact. It is not at all easy to acquire land in India. So would you prefer to invest in India or Taiwan or China in that case? So I hope you understand my point here. Tax rate is one of the factor, but by only reducing tax rate without addressing other concerns, other issues, you will not be helpful or you will not be successful in attracting lot of investments. That is the second issue here. Third issue, have a look at this. There are various other policies of the government of India. Right? There are various other policies of the government of India which are a cause of concern, which are concerning for private sector companies, for foreign companies to work in India. For example, the government of India has many policies such as higher custom duties on imports. Right? Government has very high custom duties on imports. Right? So don't you think that will basically deter foreign companies to invest in India? Many of the times government of India will say, if you want to manufacture, right, you will have to procure some of the goods from Indian companies only. That kind of policy will not be helpful in attracting investments. So no doubt, reduced corporate tax rate, right? No doubt, it is an attractive option for the investors. But only reduced corporate tax is not going to be helpful. You'll have to implement many other policies, many other reforms to address the issue regarding, right, let's say skilled labor, land acquisition, many of your policies, right? I'll give a current affairs example so that you understand it. Couple of months ago, I'm pretty sure all of you have come across this. Did government of India initially announce that if you want to import a laptop, you'll have to take a license? Let me know, right? Please let me know whether did you come across this or not. Right? Government of India initially announced you want to import a PC, you want to import a laptop, take a license. Initially they announced it, but later government of India changed the policy and stated you don't need to take a license, you need to simply report it. Correct? Initially they said take a licensing policy, right? And government of India later realized, because there was a backlash. Many of the companies, many of the investors opposed it. Then government said no, you don't need to take a license, you need to simply report it, right? Because we are worried about national security. We are worried about the imports are coming from whether trusted sources or untrusted sources. So I want you to simply report how much you are importing, right? So there was no prohibition of imports. Now there was no issue with related to imports, only you needed to report from where you are importing, right? They called it as an import management system, right? Rather than licensing system, now they called it as import management system, right? But again, please understand, these kind of policies, whenever they're announced by the government, no doubt they are done with certain objective. I'm not saying these are illegal policies or anything of that sort. They are announced keeping in mind certain objectives, but they may or may not be acceptable to the investors in the market. So these are some of the benefits and these are some of the issues or concerns. Can we go forward now? Now, before going forward, many of you started asking, is exemption same as deduction, etc., etc. I'll give you certain points. Please listen carefully. Please listen carefully. Exemption talks about your income sources, right? Even some of the charities, right? Some of the charity that you do, that is also exempted, completely exempted. So exemptions are those where the income sources are exempted from taxes, right? For example, if you're earning 5 lakh rupees from agriculture sector by farming, there is no concept of deduction here, there is a concept of exemption. Your complete income is exempted. That will not even be considered for calculation of taxes. But on the other side, deductions, in case of deductions, you make expenditure out of your income, you will take money and you will spend money. Some of it, not all of it, some of it, on this, you will not be asked to pay taxes. You will not be asked to pay taxes up to certain limit when you incur expenses in the market. That is deductions. And some of you are asking, sir, what kind of deductions are provided for companies? I'll tell you now. Please remember, later also you'll need it. If you pay money for depreciation, do you remember the term depreciation? Please do let me know. Right? Do you remember the term depreciation? If a company incurs expenditure up to certain limit on depreciation, right, you can claim it as deduction. There is also concept of a dividend. There is also concept of dividend. If you pay dividend, that is also that is also deductible, tax deductible. Now, what is this dividend? Let me explain it. Please listen carefully. Imagine there is a company. I'll take a current affairs example so that you understand. All of you heard of Adani company, Paytm company? All of you heard of Infosys company? So all these companies, the examples that I've given just now, they have shares in the market. Correct? Shares are there. You can purchase shares, you can sell the shares. Now please understand, any shareholder, right? What do you mean by share? It is a part of ownership. Shares are nothing but they represent ownership in a company, right? So whenever I say shares, can I say these are owners of a company? Let me know. If you have 10% shares of Adani company, congratulations, you are 10% owner of Adani company. Imagine you have a 5% shares of Infosys company. Congrats, you are 5% owner of Infosys company. So is the logic okay? Shareholders are nothing but owners. Now let me ask you a simple question. The profits generated by the company belong to whom? Answer this question. Profits generated by the company belong to whom? Right? Do they belong to, right, the government of India? Do they belong to, right, you? Do they belong to me, etc.? No, it belongs to the owners. Who are the owners here? Shareholders are the owners. Shareholders are owners, correct? Now, whenever the company will earn a profit, part of the profit, not all of it, part of the profit, they will give it to the shareholders. This is called as dividend. This is called as dividend. Any problem? I'll repeat it again. Whenever the company earns profit, part of the profit is given to the owners who are nothing but shareholders. That part of the profit which is given to the owners, it is called as dividend, right? Even dividend that is paid by the company is a tax deductible. It is also tax deductible. So depreciation, dividends, etc., all of these are tax deductibles. Can we go forward? And next one is a rebate. Next one is rebate. Many of you are asking, sir, why will I pay more money? Right? Why will I pay more money than what am I mandated? My dear, right? Don't you think sometimes, not all of you, sometimes some taxpayers might miscalculate the amount of tax payable? Please do let me know. Sometimes, not always, sometimes some of the taxpayers might miscalculate some of the tax that is payable to the government. Possible. That is one situation. Second situation, in many of the cases, government only says, right? Let's say hypothetically, right? I'm earning salary from the company, and lot of deductions have already been made from the salary. Lot of money has been deducted. That is a taxes. Tax amount has been deducted and has been given to government. I have made a payment to PPF that was not considered by the company while deducting the taxes. I have made contribution, right? Let's say in the form of the loan repayment on my housing loan. That was also not considered by the company while calculating the taxes. Now, don't you think because the company has not considered my ATC deductions while calculating the taxes and giving it to government from my salary, now I will file these documents with government of India saying that I need these particular deductions. Don't you think now government will calculate all of it and give me excess income tax that I've paid to government of India? Please think of it. Right? Possible or not? Right? So I hope you understand. Many cases we pay excess amount of taxes because of various issues. Tax authorities will calculate and say, this is the extra tax that you have paid, please take it back. Right? We will rebate it back to you. Right? So rebates, deductions, right, as well as exemptions. All the three are technical terms. Please remember it. Okay. Now, let me go forward. Right? Concept of capital gains tax. Concept of capital gains tax. Now, what is this idea of a capital gains tax? Please listen carefully. Imagine today you have 5 crore rupees. Imagine today you have 5 crore rupees. Again, crore-patis, right? Early morning, you are crore-patis. Congratulations. Now, you will use this 5 crore rupees to invest and purchase an asset. You'll use this 5 crore rupees to invest and purchase an asset. Now, this asset can be movable asset. The asset can be movable or asset can be immovable. For example, sir, what do you mean by movable asset? You will purchase, right? Let's say sovereign gold bonds. You will purchase shares. Can I say these are movable asset? That is, you can move these assets. On the other side, immovable asset, land. Land is an immovable asset. What about homes? That is flats, etc. That is also immovable asset. So you have 5 crore rupees. You will use that 5 crore rupees, purchase an asset, movable or immovable. Now you will own the asset for a certain time period and you will sell the asset after certain months or after certain years in the market at, let's say, 6 crore rupees. You will sell it in the market at 6 crore rupees, right? After, let's say, 3 months, after, let's say, 6 months, after 2 years, or after 5 years, doesn't matter. Don't worry about the time period. I'll come to time period after 1 minute, right? So you have sold this asset in the market at 6 crore rupees. Now, can I simply say by purchasing at 5 crore, by selling at 6 crore, you have made certain profits in the transaction, correct? By purchasing at 5 crore and selling at 6 crore rupees, you have made certain profits. We call it as profits. Government will call it as capital gains, right? So whenever you purchase an asset, own it and sell it later, right? The profits that you make, extra earnings that you make, it is called as capital gains. And on such capital gains, government will impose the taxes and collect the taxes. That is called as a capital gains tax. Anybody has a problem with this? Please do let me know. Anybody has a problem with this? For example, you purchase land and sell it at a higher price, government will impose capital gains tax. You purchase bonds, sell it at a higher price, you will purchase, government will impose capital gains. You purchase shares, sell it at a higher price, government imposes capital gains. Right? So capital gains tax is applicable on certain assets which are purchased and later resold, later sold at higher price, right? And on this additional earnings that you have made, government will impose a tax and collect. That is called as capital gains tax. Now, point number two. Point number two, whenever you talk about purchasing and selling an asset, generally there are two types of taxes within capital gains tax. Capital gains tax is again divided into two types. One is called as short-term capital gains tax. Second one is called as a long-term capital gains tax. Now, what is the short-term and long-term? Understand this. Initially, when this idea of a capital gains tax was introduced, initially, you purchase an asset, hold it means own it for 3 years and sell after 3 years. I'll repeat the statement. Example 1, please look at this very carefully. You purchase an asset, let's say in 2023, sell it in 2025. Can I say you had ownership for 2 years? Any problem? You purchased the asset in 2023, you sold it in 2027. Can I say your ownership was for 4 years? The ownership period is also referred to as holding period. Ownership duration is also referred to as holding period. So if your ownership was below 3 years, right? If you held on to the asset for below 3 years and then sold it in the market and you made capital gains, then the government imposed a short-term capital gains tax. Short-term capital gains tax. Is it okay? I'll repeat it again. You purchase an asset, own it for up to 3 years. Up to 3 years. That is, you can sell it after 1 year, after 3 months, after 1.5 years, but below 3 years. Then the government imposed a short-term capital gains tax. And if you own the asset for more than 3 years and sell it, the government imposed a long-term capital gains tax. Long-term capital gains tax. So below 3 years, short-term. After 3 years, long-term. So when initially the capital gains taxation was implemented, it was uniform. It was simply uniform. Below 3 years, after 3 years. But later government of India has kept on changing the holding period for many of the assets. For many of the assets, holding period has been changed. For example, if you purchase a land and sell the land before 2 years, government will impose a short-term capital gains tax now. If you purchase and sell it after 2 years, government will impose long-term capital gains tax. You purchase a share and sell it before 1 year, government will impose a short term. If you sell it after 1 year, government will impose a long term. Right? So again, the point is very simple here. I've written it. The short term and long term capital gains tax, how it is implemented, it depends upon holding period, ownership period. And the ownership period is not uniform now. It has been changed. For some of the assets, ownership period is 1 year. For some of the assets, ownership period is 2 years. And for some of the assets, ownership period is 3 years. Now, please tell me, if you have different kinds of ownership period like this, don't you think the taxation system will become much more complicated? Think of it, right? Don't you think the idea is, if you have different, right, let's say owning periods or holding periods like this, 1 year for some assets, 2 year for some of the assets, 3 years for some of the assets, don't you think taxation system becomes unnecessary, more complicated? And that is actually what has happened. And that is the reason why there are a lot of demands, right? Lot of demands regarding restructuring capital gains tax in India. Lot of demands are there from experts to restructure capital gains tax structure, right? And that is the reason next year, not this year, right? Although we are in the month of December, next year, right, the government is expected in the budget to make certain announcements regarding capital gains tax. This year we expected that, it has not happened. Next year we are expecting in the budget in the month of February, government will make certain changes to make capital gains tax structure much more simple. Can we go forward? Can we go forward? Sir, what will happen if I sell it at losses? My dear, you please tell me. You please tell me, if you sell it at loss, that is you purchase at 5 crore and you sell it at 3 crore rupees, is there a capital gains or capital loss? Think of it and do let me know. You purchase at 5 crore and you sell it at 3 crore, will you have capital gains or capital loss? You'll have a capital loss. And if you have a capital loss, do you think government will impose taxes on you? Does it make sense to you? Right? Do you think government will impose losses on you and collect taxes from you when you're incurring losses? Obviously no. Obviously no. Right? So I hope you understand. Don't worry. Whenever you make losses, government will not impose taxes when you make losses. It's like saying, sir, I'm earning 0 rupee income. What is the income tax I'll have to pay? I hope you understand. I'm earning 0 rupee income. What is the income tax I'll have to pay? When there is no income, how can you pay income taxes? Right? Does it make any sense? No. Right? For example, when I discuss corporate taxes, many of you will keep on asking me, sir, if the company has incurred a loss in one financial year, do they pay corporate taxes? My dear, corporate taxes are imposed and collected out of corporate profits. Correct? The idea is, you have made profits and I will collect some of the profits in the form of taxes. But if you have not earned any profits, how can government impose and collect corporate taxes from you? Not possible. Not possible. Okay. Now, let me go to the next concept, tax avoidance. Tax avoidance. Now, before I start with tax avoidance, I'll introduce two more concepts here. Idea of tax avoidance, and tax evasion. Many of you will come across these terminologies in the newspaper, in the current affairs, etc. Both are different, both are not one and the same. Tax avoidance, tax evasion. Tax evasion is illegal. Tax evasion is illegal. Tax avoidance is not illegal. Right? Tax avoidance is not illegal. Tax evasion is illegal. Please understand the terminologies very carefully. In tax evasion, you will reduce your tax liability. You will reduce your tax liability. And tax avoidance, you will again reduce your tax liability. Now, let me give you one example of tax evasion. Then we will discuss multiple examples of tax avoidance. Let's start. Imagine I'm earning 5 crore rupee income this year. I'm a real estate developer. I'm earning 5 crore rupee income this year. And because most of the transactions, right, the transactions that I've conducted are in the form of cash transactions, when I'm supposed to file income taxes, when I'm supposed to pay income taxes to government, instead of saying that my income is 5 crore rupees, I will simply tell the government my income is 2 crore rupees. Right? Instead of saying my income is 5 crore, I'll simply tell the government my income is 2 crore rupees, which is nothing but I have underreported my income. I have underreported, right? I've reduced my income when I'm supposed to pay taxes to government. Now, please tell me, can I call it as a tax evasion? I've reduced my tax liability by using certain illegal methods. You're not supposed to underreport your income. You're supposed to report your correct income. I'll give you one more example. I've got certain amount of money and somehow I've invested this money outside India. Right? I've invested this money outside India. Is it allowed? Of course, yes, it is allowed. Many of you will have this doubt. Sir, are we allowed to invest outside India? Yes, you are allowed to invest outside India. So I have got the money. I've invested this money outside India. I've generated profits from this. I will not report it to Government of India. I've earned profit, but I will not report it to Government of India. Can I say this is tax evasion? I have certain assets outside India. I will not report it to Government of India. Again, tax evasion. So using illegal methodologies to reduce a tax liability is called as tax evasion. It is called as tax evasion. Now, what is the tax avoidance? Tax avoidance, please understand, these cannot be called illegal. Tax avoidance is not illegal. Please understand me very carefully. Tax avoidance is using certain actions or performing certain actions as a result of which your tax liability will come down, and these actions are not illegal. Is it okay? I'll repeat the definition again. Tax avoidance simply means performing certain actions. The taxpayer will perform certain action which are not illegal, but as a result of this, tax liability will come down. This is called as tax avoidance. Now you'll ask me, sir, what is the example? Please give me an example to make me understand what is tax avoidance. Let me start. Let me start with an example here. Look at the example very carefully. Do not by heart calculation, but please listen to me very carefully. Look at the example. Imagine example 1 and example 2. Company A is working, right? Let's say in India, where the tax rate is 30%. Okay? Country 1, where the tax rate is 30%. Now, let's say hypothetically, company A will manufacture a product at 1000 rupee, sell it at 5000 rupee in the second country. Can I say company A has generated profit of 4000 rupees in country 1? Anybody has a problem? A has manufactured it at 1000, sold it at 5000 rupees, sold it at 5000 in another country. Can I say in country 1, company A has registered a profit of 4000 rupees? Now, if nothing else is considered, don't worry about everything else. If on 4000 rupee, if you calculate corporate taxes, can I say company A will pay corporate tax of 1200 rupee? Correct? Company A will pay a corporate tax to the government of 1200 rupee. Example 1. Now come to example 2. Right? Company A will open up one more company. In the second country. Company B. Can you see this vertical white line? Vertical white line is nothing but border. Okay, this is nothing but border. So company A will open one more company in second country. Now many of you ask me, sir, why they will open, etc. You'll understand. Instead of opening, they might purchase a company in second country. Anything is possible. Now please tell me, if you are the owner of company A, is it illegal for you to purchase a company or set up another company in second country? Think of it and do let me know. Right? You are the owner of company A. Is it illegal for you to open one more company in the second country, or is it illegal for you to purchase another company in the second country? Absolutely no. It is not illegal, right? Please be very careful. It's not illegal. It's perfectly legal. You have followed all the guidelines. You have reported that to the government also, that you are investing there, opening a company, you are purchasing a company. You have given all the documents. Now what will happen? Understand this. Company A will manufacture a product at 1000 rupee rather than directly selling in the second country. It will sell the bottle, or let's say it will sell the product to company B at 1200. Now company B will sell this bottle or the product to the consumers in that respective country at 5000 rupees. Question number 1, please tell me, based on this, based on the example 2, please tell me how much is the profit generated by company A. Let me know. Based on example 2, look at example 2 and tell me how much is the profit generated by company A. Can I say company A has generated 200 rupees? Right, some of you are saying 4000 rupees. How? I'm asking company A example 2. Company A example 2. Right, so in company A, it has manufactured at 1000 rupee, sold at 1200. So company A will register a profit of 200. Can I say company B has registered a profit of 3800? Company B has registered a profit of 3800. So now calculate the taxes. So in country 1, the tax rate is 30%. Out of 200, 30% will become 60 rupee tax to the government here. Out of 3800, the tax rate is 10%. The tax that will be paid will be 380. So now please tell me, compared to example 1, don't you think in example 2, you have paid lesser taxes to government? I'll repeat it. Compared to example 1, in example 2, have you paid lesser taxes to government? Of course, yes, you have paid lesser taxes to the government. Now, please understand, this is not illegal. This is not illegal. You are avoiding, no doubt, you are avoiding taxes. But this is not illegal. This is perfectly legal. And many companies do this. Many companies simply do this, right? They might use this strategy, or there is a strategy called as IP restructuring, right? Many companies actually follow the tax avoidance measures in order to reduce their tax liability. Best examples for this, best examples of this, have you heard of company Google? Anybody in the classroom who says, right, Google, right, I don't know what is Google, right? The name of the company is Alphabet, right? Google was earlier the name, now it is Alphabet. Have you heard of the company Apple? Right? Have you heard of the company Facebook? Right now, Meta. Right now, of course, called as Meta. Right? Or Amazon for that matter. In fact, many countries, right, call these 4 companies as GAFA. GAFA. Right? GAFA. GAFA. Right? Right? These are multinational companies. These are multinational companies. And these companies are known to be using these kind of strategies where they are avoiding lot of taxes to the government of USA. Is the logic okay now? Please do let me know. Can I go forward? So what has happened here, right? The company A or the owner of company A has used certain strategies in order to reduce the tax liability. It's not illegal, but can the government sit quietly? Of course, no. Government cannot sit quietly. They will try to take certain measures. They will try to take certain measures. We'll discuss those, right, going forward. Right. So this is the basic idea for tax avoidance. Can we go forward? Anybody has a problem? Now there is a term called as a transfer price here. There's a term called as transfer price. What is the meaning of transfer price? Whenever there is a transaction in the sense, whenever a company will transfer a good or a service to another company, the money that the company will get, it is called as a transfer price. Is it okay? I'll repeat it again. Whenever a company will sell anything, sell means transfer anything, good or a service to another company, how much money the company will get instead of the good or service, it is called as a transfer price. Transfer pricing is also used to conduct tax avoidances by multinational corporations or multinational enterprises. That is called as tax avoidance. Let me introduce one more concept here itself, although there is a subsequent slide on it. There is a term called as base erosion and profit shifting. Base erosion and profit shifting. Now, what is this idea for base erosion and profit shifting? Please keep on looking at example 2. Keep looking at example 2. Listen to my statement. In example 2, we can see base erosion and profit shifting. Now, what is the base erosion and profit shifting? The tax base in country 1 is reducing. Why it is reducing? Because the companies are shifting their profits from one country where the tax rate is higher to another country where the tax rate is lower. I'll repeat it. Listen to me carefully. Look at example 2. There is a base erosion and profit shifting observed in example 2. Now, what is this base erosion and profit shifting? The companies are transferring or shifting their profits from one country where the tax rate is higher to another country where the tax rate is lower. And because they're shifting their profits, in country 1, the tax base is shrinking. The tax base is coming down or reducing. This process followed by the companies is called as base erosion and profit shifting. Anybody has a difficulty in understanding the definition of BEPS, please do let me know. Let me know, right? Anybody has a difficulty in understanding what is base erosion and profit shifting? This is very, very common. I repeat, this is very common. Countries are concerned, countries are taking measures. I'll come to that. This is very common, but anybody has a problem? But for this country too, tax liability has to be low also. If it is more than India, then it is not going to work. Of course, yes. That's the reason example that I've taken is country 1 has a tax rate of 30%, country 2 has a tax rate of 10%. You tell me, if you are the owner of company A, will you shift your profits to any country where the tax rate is more than 30%? What is the logic behind it? You will not do that. You will not do that. You will look at a country where the tax rates are very low. In fact, please remember, there is a term safe haven, right? Or else they will call this as tax havens. Tax havens. Why these are called as tax havens? Many countries around the world are called as tax havens. For example, Mauritius, right? Cayman Islands, Panama Islands, British Virgin Islands. These are called as tax havens. Why these are called as tax havens? Even for that matter, Netherlands, it is called as a tax haven. Reason being, the tax rates is very low, negligible, very low, negligible, or even in many cases 0%. The tax rate in such countries is very low, negligible, or even 0%. Now, if you are the owner of the company, you will be in search of these kind of countries only, where the tax rates are very, very low, because you don't want to pay 30% out of your profit. You want to pay 2%, you want to pay 1%, you want to pay 10%, and if possible, you want to pay 0% out of your profits. So many companies, multinational enterprises, are in search of such tax havens itself. And these four big companies, right? Google, right? That is Alphabet now, right? Google, Amazon, right? Or for that matter, a Shell company. The name of the company itself is Shell. Shell company, right? Or for that matter, Facebook. All of these are known to be employing tax avoidance strategies in order to reduce their tax liability. Okay, can we go forward? This is the concept of base erosion and profit shifting. Companies will use strategies to shift their profits from one country where the tax rate is very high to another country where the tax rate is very low. And this process is called as base erosion, profit shifting. Base erosion and profit shifting. Okay. Now, what is the problem with base erosion and profit shifting? Imagine, right, you are the government of country 1. Imagine you are the government of country 1. Would you be happy with base erosion and profit shifting done by the multinational enterprises in your country? Think of it. Would you be happy with the BEPS that is conducted by companies in your country? You should not be happy. Why? You are losing lot of tax revenues. You are losing huge amount of tax revenues. And that's a concern, especially for a developing country such as India compared to a developed country such as USA. No doubt USA is also losing tax money. I'm also losing, that is India is also losing tax money. But don't you think a developed country, the problem of tax avoidance will be a problem for all the countries. But in terms of importance of tax revenue, it has a higher implication for a developing country compared to a developed country, because a developing country will have more reliance on tax sources, right? In fact, I told you this yesterday, more than 55% of our income comes from tax sources. Whereas a developed country such as USA, they will have different sources. Apart from taxation, they'll have different sources to collect income. So it is a bigger worry, bigger concern for developing countries compared to developed countries. So what we have done, what has been done, many countries have come together. That is more than 140 countries, including India, by the way, have come together, and we have signed, right, a particular document. We have signed a particular document under which multiple reforms are being proposed. And the name of the document that has been signed is nothing but BPS Action Plan. BPS Action Plan simply means Base Erosion Profit Shifting Action Plan. Now, this document has been signed by more than 140 countries. It also has right membership, or it also has member countries of OECD. OECD stands for Organization for Economic Cooperation and Development. Organization for Economic Cooperation and Development. And G20 is basically group of 20 countries. India is a member of G20. So OECD and G20 has come together. They have proposed a set of 15 measures. I repeat, it has proposed a set of 15 policy measures which should be undertaken by the member countries in order to reduce tax avoidance. And this set of 15 measures is called as BPS Action Plan. Now, if you ask me, sir, should I remember all the 15 measures? Not needed. It is of no use for UPSC. These are very, very technical in nature. These are very, very technical in nature. You don't have to remember all of these, right? Not even needed. So simply remember, OECD plus G20 came together. They have introduced an action plan called BPS Action Plan, under which 15 measures have been proposed, using which they want to address the issue of base erosion and profit shifting. Right? Anybody has a problem? Can I go forward now? Can I go forward? Anybody has an issue? Please do let me know. Now, what is the latest reform? Current affairs. What is the latest reform? Understand this very carefully. Now, more than 140 countries have come together and they're signing an agreement, global agreement. They're signing a global agreement by the name of Global Minimum Corporate Tax. I'll repeat the statement here. More than 140 countries have come together now, and now they have signed one more agreement, which is called as Global Minimum Corporate Tax Agreement. Under the GMCT, Global Minimum Corporate Tax, there are two pillars, Pillar 1 and Pillar 2. What is done under Pillar 1? Listen carefully. Under Pillar 1, it is applicable to the multinational enterprises which have a revenue of more than 20 billion euros. All the multinational enterprises which have a revenue of more than 20 billion euros will be covered under this. Now, what will be done under Pillar 1? Right, I'll explain this. Listen carefully. Imagine there is a foreign company, multinational enterprise, which is using the customer base of India, right? Customer base, more than 130 crore people in India. So which is using the customer base of India and is generating huge amount of revenue. But when they're supposed to pay taxes, they are paying taxes on their profits in a country such as, let's say, Netherlands. They're paying the taxes in Netherlands. Now, as a government of India, I'll be opposed to it. I'll simply say, you're generating revenue by using people from India, by looking at the customer base in India. But when it is a question of making payment of taxes, you're paying taxes somewhere else because you are employing tax avoidance strategy. In that case, now what will happen? Some of the revenues, I repeat, some of the revenues that are generated by using the customers of India from the Indian market, some of the revenues will be given to government of India. Anybody has a problem? I'll repeat it again. Listen carefully. Right? The concern here is many of these multinational enterprises are using customers of USA, customers of UK, customers of India. That is, they are generating lot of their profits from these economies, these markets. After generating profit, when they are supposed to pay taxes, they are paying taxes somewhere else. Right? They are paying taxes in a tax haven. We are not happy with that. So under pillar 1, what has been proposed? Again, it is a proposal, not yet implemented. What has been proposed? Part of the revenue that the company will generate in India now will be given, right, to government of India, will be deducted and given to government of India. That is pillar 1. That is called as pillar 1. Pillar 2, right? What is proposed under pillar 2? Under pillar 2, we are proposing a minimum corporate tax rate of 15%. Across the globe, a minimum corporate tax rate of 15%. Now, what will happen because of this? Let me explain it to you. Sir, we have proposed, what if I don't implement? What if the other country has right a lower than 10, 15%, etc.? What will happen? Please listen to the explanation. Imagine there are two countries, country 1 and country 2. The corporate tax rate in country 1 is, let's say, 20%, and corporate tax rate in country 2 is 5%. Not 5%, just to make it easier in terms of calculation, let's say 8%. Let's say 8%. Obviously, companies would want to pay corporate taxes in the country 2, so they will start shifting their profits to country 2. They'll start shifting all of their profits to country 2. Now, let's say there is a company which started working in country 1, let's say Apple. Right? Apple is a USA company. All of you okay? Apple is a USA company. Facebook is a USA company. Google is a USA company. Shell is a USA company. So imagine this company has started working in country 1. But in terms of their taxes, to pay corporate taxes, they are registered in the country 2 and they are paying 8% of their profits to the government of country 2. And now think of this, right? Let's say the company Apple has generated $100 million profits. The company Apple has generated $100 million profits. Out of 100 million in country 2, what is the tax rate? 8%. So if you calculate 8% of 100 million, if you calculate 8% of 100 million, the company will end up paying $8 million to country 2. Now, once this second pillar of global minimum corporate tax is implemented, once the second pillar of global minimum corporate tax is implemented, whatever is below 15%, when they're paying taxes, whatever taxes they have paid below 15%, that shortfall of taxes, that lower taxes will be calculated, and these taxes will be paid to country 1. What is the meaning of it? We have proposed a global corporate tax rate of 15%. But please tell me, based on the example, has the company Apple paid a corporate tax of 15% in this example? Let me know. In this example, has the Apple paid 15% corporate tax? No, it has paid only 8% corporate tax. So what is the difference? 15% and 8%, 7%. So now we will calculate 7% of $100 million. That will become $7 million, and the company Apple has to pay $7 million to country 1. All of you okay with the calculation? Anybody has a problem? Logic is simple. We have proposed a global minimum corporate tax at least of 15%, minimum 15%. Now, if a country has less than 15%, just to attract these companies, we will calculate what is the difference, right? 8% and 15%, difference is 7%. So 7% out of this 100 million will be calculated, and this 7 million Apple has to pay to country 1. Can we go forward? Anybody has an issue? This is the second pillar. This is the second pillar. This is the second pillar. Okay. Anybody has an issue? Country one is still losing 8% tax. My dear, you are looking at in a wrong way. Country one is not losing 8% tax. If there is no minimum 15% slab, if there is no minimum 15% slab, don't you think country one will not even earn $7 million? Let me know. You are saying, sir, right, country one is still losing, right, 8% tax if there is no slab of minimum 15%. If pillar two is not there, imagine, then don't you think country one will not even earn $7 million? Right? So that is the reason. And second point, please understand. Second point is, don't you think if this kind of a policy is implemented, many countries will not offer lower corporate tax rate? Correct? Many countries will stop offering lower corporate tax rate. Why? There is no incentive for Apple to be located in country 2 now. Imagine country 1 will reduce its corporate tax to 15%. Think of it. Imagine, right, country 1 will reduce its corporate tax to 15%. Now please tell me, is there any incentive for Apple to be located for payment of taxes in country 2? Think of it. There is any incentive? Is there any incentive for the Apple to be located in country 2 for the purpose of payment of taxes? There is no incentive, because now they will pay 8%. But once the pillar 2 is implemented, whether they are present in country 1 or country 2, they will end up paying 15% corporate tax. So why to be located in country 2 just to avoid taxes? There is no avoidance now. They will be located in country 1 itself. Right? So that is the reason. That is the reason second pillar has been proposed. Sir, explain pillar 1. I'll repeat it again. The companies are using the market of a country and are generating certain revenue from that country. But for payment of taxes, they are paying the taxes on all the profits, including this profit, in a tax haven. So under the pillar 1, whatever revenues they have generated from Indian market, part of that will be given to Government of India. Right? That is called as pillar 1 and pillar 2. Many countries are signing up this, and many countries are thinking to implement all of this. Can we go forward now? Can we go forward? How is that possible? My dear, is Google operating in India? Let me know. Is Google operating in India? Is Google present in India? Do we have Google India company or not? But even then, Google is not paying out of their profits. Google is not paying taxes to Government of India. They are paying somewhere else. They are simply paying the taxes somewhere else. Right? Apple, they are paying taxes somewhere else. Shell companies, right? Shell as a company, they are paying taxes somewhere else. It's a common practice. It's a common practice, right? You don't worry about how they will do it, right? Can I do it, etc. I am not asking you. I'm not going to teach you how to avoid taxes. I'm going to only tell you how they do it and what is being done. The next concept, minimum alternate tax. Right? Minimum alternate tax. MAT, minimum alternate tax. Okay. Now, what is this minimum alternate tax? Let me explain. Now, please be very careful. I don't want you to remember calculations. The objective of this discussion is not to make you understand or remember calculations. That is not needed for UPSC. But what is this minimum alternate tax? What is this concept of MAT? Right? Minimum alternate tax simply says there are certain companies which are called as zero tax companies. There are certain companies which are called as zero tax companies. Now, why these were referred as a zero tax company? Let me show it to you. Let's start with a very simple example. Do not complicate it. Do not complicate it. Let's start with a very simple example. But all of you will agree when I say, just like individuals, even the companies are allowed deductions. Let me know. Just like individuals, just like you and me, who will claim deductions, even the companies are allowed certain deductions. For example, depreciation, dividend, right, etc. These are deductions which are allowed. Now let's start. Imagine there is a company which has generated a revenue of 1000 crores and its expenditure is 800 crores. Revenue is 1000 crore. By selling, they have generated 1000 crore, but they have incurred expenditure of 800 crore. Now, if you deduct 800 crore out of 1000 crore, you will get 200 crore rupee. Now, please understand, on 200 crore, government doesn't impose a tax. On 200 crore, government doesn't impose a tax. Just like us, certain deductions will be allowed for companies as well. So, I'll call this a 200 crore as a book profit. From this 200 crore, if the company will claim deduction of 200 crore rupees, I repeat, and there are companies which do that. From 200 crore book profit, if the companies will claim 200 crore rupee deductions, then taxable income, taxable profit of the company will become 0 rupees. And if corporate tax rate is 30%, how much will be the corporate tax collected by the government? Government will collect a grand total of 0 rupee corporate taxes from this company. These companies are called as zero tax companies. Such companies are called as zero tax companies. Anybody has a problem? Please do let me know. Anybody has a problem? Those are asking what is this book profit? I'll just take a detour. Not needed for UPSC, but because you are asking, I'll just take a detour and tell you. Please remember this. Whenever you talk about any company, the company will create or will basically publish a certain financial records. The companies are supposed to, right, have certain financial documents, financial records. One such record, please remember this, one such record is called as income statement. One such record is called as income statement, financial statements. These are financial statements. And another such record is called, right, basically the balance sheet. Other one is called as balance sheet. Is it okay? Right? Instead of income statement, this is also called as a profit and loss statement. Right? Some of the commerce students will say, sir, it is not income statement, it is profit and loss book or profit or loss accounts. Now, what is the basic difference? Please remember this. In P&L statement, or income statement, we generally provide information about the revenues and expenditures. Revenues as well as expenditures. Whereas in case of balance sheet, the company will provide information regarding assets as well as liabilities. Assets as well as liabilities. Anybody has an issue? Please do let me know. Let me know. Right? One is P&L statement, which will provide you information regarding revenue and expenditure. And second one is a balance sheet, right, which will represent data regarding assets and liabilities of a company. Now come to the point here. Annually, if you keep on reading newspapers, you will come to know this. Annually, the companies will publish, right, their income statement as well as the balance sheet data. Now come to the point here. There are many companies which will provide huge amount of dividend to shareholders. Dividend is a tax deductible. There are many companies which will invest a huge amount of money and will claim depreciation. So there are companies and there are companies which will claim huge amount of deductions, and that is allowed, by the way. Please understand this. It's not illegal. Do not imagine that, sir, how can they do it? They're not allowed to do it. Why? Under the Income Tax Act and under the Companies Act, provisions are there. They're using the provisions. Nothing wrong with that. But the government of India's concern is that, let's say, a company will distribute dividend. Now, all of you know what is dividend. A company, let's say, will distribute dividend, and it will claim it as a tax deduction and will pay 0 rupee taxes to government of India. Right? Don't you think that's a concern for government of India? That is, you have sufficient money, you're earning profits, you have sufficient money to pay to your shareholders. You have money to pay to your shareholders, But when it comes to payment of taxes to government of India, you say, because right, the provisions are there, I'll pay 0 rupees corporate taxes to government of India. Right, so such companies are called as zero tax companies. These are called as zero tax companies. Right, now again, let me ask a simple question, again not related to UPSC. UPSC will not ask you this. How many of you seen Guru movie, where the hero is Mr. Abhishek Bachchan? Let me know. Let me know. How many of you seen that particular movie, Guru? Again, if you have not seen, nothing wrong with that. Don't say, sir, I have not seen it. Will UPSC ask a question on this? Right? Absolutely no. Absolutely no. If you have seen this movie, right, that is movie Guru, don't you think the actor that is hero in that is employing the same tactic? Those who have seen, do let me know. Right, those who have seen, please do let me know. Is the hero not employing same tactic, where the right Mr. Abhishek Bachchan as a protagonist will announce a large amount of dividend to shareholders, will show huge amount of depreciation because he has purchased machineries, but when it is the question of paying taxes to government of India, he'll say, I don't have money. Again, you have not seen, don't worry. Please don't worry, don't panic. UPSC is not going to ask you, tell me the tax implication of movie Guru in interviews, until unless you say, sir, watching movies is my habit. I hope you understand, right? Until unless you say, hey, sir, movies, right? Watching movies is my habit, then they'll ask you, please tell me what are the societal implications of animals such as movie such as animal. What are the societal implications of movie XYZ? What are the tax implications of movie, right? Guru, like this. But again, generally, don't worry about it. So come back to the point here. Do not complicate it. Simple understanding. The company has generated revenue and incurred expenditure, the difference between that, which is called as a book profit. Now the companies under various sections are allowed to claim deductions. They might claim huge amount of deductions, as a result of which taxable profits or taxable income of the company will come down to zero. Even if government has a 30% tax rate, government will get 0 rupee tax. Such companies are referred to as zero tax companies. Government of India is not happy, right? We'll never be happy with these kind of companies. So what we have done is, we have introduced, right, a new type of a tax called as minimum alternate tax, MAT. We've introduced a new type of tax, MAT, starting in 1971. 1971, Mr. Rajiv Gandhi was the prime minister. We introduced this with the name of minimum corporate tax, MCT, minimum corporate tax. But over a period of time, at 1996, it has been changed. The name of this tax has been changed to minimum alternate tax. Right now, minimum alternate tax is 15%. Right now, minimum alternate tax is 15%. Now you will ask me, what is this, sir? What is the use of minimum alternate tax? Let me show this to you. Let me show this to you. Okay. Again, do not worry about calculations. UPSC will not ask you calculations. But tell me, using MAT, whether government will be able to collect certain amount of taxes from the companies or not. Look at the table. Let's start with the same number. Company will generate a revenue of 1000 crore. Out of that, expenses is 800 crore. The difference is called as book profit. And some of you will ask me, sir, if there is a loss, if there's a book loss, will the government collect the taxes? Of course, no. If you have generated lower revenue compared to your expenses, right, how can you generate, or how can government collect taxes in that situation? Right, there is no taxes there, only when there is a book profit. So 200 crore is a book profit. Now they'll claim deductions of 200 and taxable profit will become zero. Now under the MAT system, under minimum alternate tax, this is how taxes will be calculated. Government will calculate 30% of taxable profit or 15% of book profit. Is it okay? I'll repeat it. Government will calculate 30% of taxable profit or 15% of book profit, whichever is larger, government will collect that. Anybody has an issue, right? I'll repeat it. Anybody has an issue, I'll repeat it. Please listen to me carefully. Right? So government will calculate 15% of, right, the book profit, 15% of book profit, or 30% of taxable profit. Whichever is greater, government will collect that in the form of corporate taxes. So in this example, can I simply say this company, even though it is claiming deductions, it will end up paying 30 crore rupees in the form of taxes to government of India? Let me know. Right? Even though the company is claiming deductions, can I say the company will end up paying 30 crore rupees in the form of taxes to government of India? This process of imposing taxes on zero tax companies is called as minimum alternate tax. Can I go forward? Right? Can I go forward? Right? The process of collecting certain right amount of tax, minimum amount of tax, right, by looking at the book profits as well as the taxable profit. This process is called as minimum alternate tax, MAT. Anybody has a problem? Anybody has a problem? Can we go forward? Some of you are asking, can every company do this? My dear, if you want to claim depreciation of, let's say, 100 crore rupees, you'll have to show that you have purchased machines of 100 crore rupees. Think of it. Please let me know. It's do not imagine like they do in pictures, like they do in movies. Reality is not like that. If you want to show a depreciation of 100 crore, don't you think you'll have to submit proof? You'll have to submit documents which shows you have purchased machinery of 100 crore. And government says, if you have purchased machine of 100 crore, show me the documents, show me the proof, claim depreciation as a deduction. Nothing wrong with that. Right? Can we go forward? Anybody has an issue with MAT? Do not worry about calculations. Please do not worry about calculations. UPSC will not ask you calculations. If you don't trust me, look at last 10 years question papers, you will realize it. But focus on the concept. Zero tax companies are there. They are avoiding taxes. Now to address this issue, we have introduced minimum alternate tax. That is a concept of MAT. Sir, but depreciation doesn't include in expenses. It is included. Can you understand what I'm talking here? Can you understand? Right? Your expenses, that's a different document. While paying taxes, you can claim certain deductions. You're talking about two different things. Don't worry. Okay. Because please understand this. Taxes are imposed on profits, not on expenses. Is the logic okay? Taxes are imposed on profits and not on expenses. Okay. Let me go to the next concept. GAR. General Anti-Avoidance Rules. Right? I've written arrangement here, but it is rules. Okay. General Anti-Avoidance Rules. GAR basically stands for that. Now, what is this general anti-avoidance rules? Let me explain. I'll take one example, and many of you are asking me, sir, should we remember all these examples, technical calculations? My answer is no. UPSC doesn't want you to remember all these calculations, right? Trust me, otherwise you'll keep on making all of these complications. Let me start. Government of India has introduced a policy called as SEZ policy. Tell me how many of you have read regarding SEZ law recently in the newspapers? Let me see how many of you are reading newspapers, by the way. How many of you have read regarding very recently the SEZ amendment that has been introduced by the government of India? Right? Those who are asking, was it there in the newspaper? Of course, yes, my dear, it was there in the newspaper. Very recently, couple of weeks ago, it was there in the newspaper. Special economic zones. And because I'm asking you a question regarding newspapers. Hindu newspaper today. Hindu newspaper, what are the important articles? I hope you people are reading. Otherwise, there is no point in doing all of this exercise. First one, right? There is an article regarding ethanol conundrum, ethanol production in India. Central page article. Very nice. Read it. Although the concept of ethanol as a combination to the fuel, not purely economics, it is more of a S&T, economics, international relation, right? It comes under various areas, but I would strongly recommend, please read that article. Please read that article. Second one, India has decided to import sugar. Business page. India has decided to import sugar. That is again connected to ethanol only, ethanol policy. Read that. That is also a very nice article, small article. Third one is Operation, Operation Prosperity, Operation Prosperity Guardian, Operation Prosperity Guardian. Now, please tell me how many of you, couple of days ago, I'd asked you to read one of the open editorials in Hindu, which spoke about Red Sea. I'll go back to taxation. Many of you are asking, where is taxation? This is not taxation. I'll go back, don't worry. I'd asked you people to read one open editorial regarding issues, right, regarding Red Sea. In recent times, lot of discussion is happening. This Operation Prosperity Guardian, very important as far as I'm concerned. Again, purely not economics, international relations, security, etc. It is there in international page. It is there in international page in today's Hindu newspaper. Please read that. Very, very important as far as UPSC is concerned. Operation Prosperity Guardian. Next one. There is one more article regarding RBI and alternate investment funds, AIFs. Business page. Please read that also. Next, there is one more article regarding GST appellate tribunals. GST appellate tribunals. Business page. Read it. Sixth article, central government has allowed states to borrow more. States to borrow more. States are allowed to borrow more in the current financial year. Important article, read it. So today's Hindu, as far as I am concerned, economics, not purely economics, all of them are not purely economics. Some of them will fall under S&T as well as in the international relations, in under the security, etc. But if you ask me, right, sir, as an economics faculty, which articles from economic perspective are important? These 6 articles. Yesterday there were only 2. Today there are 6. But again, having said so, not very big articles, very, very small articles. In fact, if you look at all of them, the biggest article is the first one. Ethanol blending conundrum. Ethanol blending dilemma for India. That is the biggest article. This is only one column like this, right? This is slightly bigger. Again, not very big, slightly bigger. 4 to 5 columns, right? 2 columns, right? 1 column, 3 or 4 columns. So my recommendation is, please read all of these articles. Now, whenever I'll give you these articles, I want you people to read it. You may not understand initially. No problem. Nothing wrong with that. But I want you people to read them. Right? Otherwise, please understand, there is no point. Absolutely no point in me telling you to read. You will say, right? You will keep on telling, who will listen to you? Go. Right? You are giving me recommendations. Right? I will not accept your recommendations. Then your loss. Right? So come back to the discussion here. GAR. What is GAR? General Anti-Avoidance Rules. Now, why is the GAR implemented? What is the importance of GAR? Let me explain using one example. Government of India has a policy called as Special Economic Zone Policy, SEZ policy. Now, under the SEZ, understand this very carefully. If you set up your company within this zone, special economic zone is nothing but area or region. If you set up your manufacturing facility or a service sector unit within this zone or within this area for 5 years, you can have 100% tax deduction. You can claim 100% tax deduction. Do you understand the statement now? Please do let me know. Out of your profits or on your profits for 5 years, you can claim 100% tax deduction. Meaning what? Imagine you are a manufacturer unit, you are outside SEZ, and let's say corporate tax rate is 30%. If you earn a profit of, let's say, 1,000 rupee, can I simply say, out of 1,000 rupee, you will pay 30% of it to Government of India? That is, you are outside SEZ. But imagine you are within SEZ, Special Economic Zone, for 5 years. Whatever profits you generate, 100% tax deduction is allowed. 100% tax, I'm sorry, not deduction, exemption. 100% tax exemption, which means you do not have to pay any taxes. You do not have to pay any taxes on your profits for 5 years. Now, how this policy can be misused? How this policy can be misused by companies in India? I'll show it. Let's say example one, there is a special economic zone. Company A is present, right, in the special economic zone. Whatever profits the company A is generating, all the profits are exempted, because basically, right, 100% tax exemption is provided. Company B is present outside SAZ. I'll repeat. Company B is present outside SAZ, and outside SAZ generally means domestic tariff area. If it is present outside SAZ, whatever profits are generated by the company B, 30% of it they will have to pay to Government of India. 30% of it they will have to pay to Government of India. Now come to example 2. Listen carefully. Come to example 2. Imagine company B, rather than selling and directly reporting profit, now will manufacture the product. Okay, will manufacture the product, let's say at 1000 rupee, rather than directly exporting, now it will purchase company A. Company B will purchase company A, or else they will set up company A in special economic zone. They will sell it to this company A at 1200. Now company A will export it to USA. Company A will export it to USA. Now please tell me, instead of company B directly exporting to USA and generating profits, right? Let's say at 5,000 rupees. Those of you who are going to ask, sir, what is the price, etc., etc. In example 1, if company B, which has manufactured it at 1000, exports it at 5,000, can I say company B would have generated 4,000 rupee profit here? I'm taking same number so that you understand. But in case of example 2, what they've done is, they will manufacture it at 1000. They will simply enter into an agreement with company B, enter into an arrangement with company B. They will sell it to company B at 1200. Now, by selling it at 1200, can I say company B is generating a profit of 200 rupees. And company A, which will purchase it at 1200, export it at 5000, will generate a profit of 3800. But because the profits are exempted, company A will not pay any taxes here. Company B will end up paying 60 rupee taxes to government. Now please look at example 1 and example 2 and tell me, because of this arrangement between A and B companies, I repeat, example 1 and example 2, please look at it. Can I say, because of this arrangement between A and B, government is losing tax revenues? Anybody has an issue? I'll repeat it again. There is an arrangement between company A and company B. Because of this arrangement, is government losing tax revenues or not? Of course, yes. Can I call it as a tax avoidance? Is it okay? Can I call it as a tax avoidance? It is a strategy which has been used by the companies to avoid taxes, right? Because they know that in SCZs, right, the tax rates are 0% for 5 years. They will enter into such arrangements. Such arrangements which are done to avoid taxes are called as impermissible avoidance agreement. I'll repeat it. Such arrangements, right, which are entered into to avoid taxes between two companies, when such arrangements are made to avoid taxes, these are called as impermissible avoidance arrangements. You are not supposed to enter into such arrangements. Why? Please understand. You are entering into such arrangements and not for commercial benefit. There is no commercial benefit here. You are entering into such arrangement to avoid taxes. Is it okay? You are entering into this arrangement to avoid taxes. There is no commercial benefit here, right? So such arrangements are not allowed, hence called as impermissible. Now, what will be done? if now the government of India comes to know this is an impermissible avoidance agreement or arrangement, what will the government do? Government, whatever benefit they are giving to company B in terms of tax exemption, they will not give this tax exemption to company B. Is it okay? I'll repeat it. Whatever benefit they are giving, what was the benefit for company A? 100% tax exemption. You generate any profit, you don't have to pay 30% taxes. You can pay 0% taxes out of it. That was the benefit. So government now will come to know these company A and company B have entered into an impermissible avoidance arrangement just to avoid taxes. So now whatever benefit I've given to company A, I will withdraw it. So whatever profits are generated by company A now will be taxed at 30%, not at 0%. Now look at this. For company A, instead of 0%, if I impose a tax at 30%, do the calculation, you will understand it. Right? Instead of, what is the number? 3800. The number is 3800 here and 200 here. Let's do the calculation. In example 1, the company B generated a profit of 4,000. On this, 30% tax was paid, which will take the number of the amount of taxes collected by the government to 1,200. In example 2, right, company B is generating a profit of 200. On this, 30% is the tax. That will become 60 rupees. And company A, if the tax exemption is withdrawn, government says you are involved in IAA, I will not give you any tax exemption. So you will also pay taxes at 30%. That will make how much? 3,800 into 30%. Can I say 1140? Now government will again collect 1,200 rupee tax. So all of you okay with this? All of you okay? Right? The process which is used by the government. The process which is used by the government is called as GAR. GAR is a policy. General Anti-Avoidance Rules is a framework. It is a set of guidelines. It is a policy under which the tax officials will find out if the arrangements are impermissible. And if arrangements are impermissible, then whatever tax exemption has been provided, those tax exemptions will be withdrawn. They will not be provided. They will be withdrawn. And when the exemptions are provided, government will impose taxes, collect as usual taxes from these companies. This is called as general anti-avoidance rules. Right? So companies enter into various arrangements which lack any commercial substance, and these are made just to pay less amount of taxes. And now government says, right, government has introduced a set of a framework or a set of policy guidelines under which tax officials will collect the data from all these companies. Now the tax official will simply say, this is an impermissible avoidance agreement. Tax exemption not allowed. You will have to pay as usual the 30% taxes. Right? So that is basically the concept of GAR. Okay, so GAR provisions have come under Income Tax Act of 1961. GAR was initially proposed to be introduced back in 2009, but later it was postponed, and finally it has been implemented starting 2017 in India. Right, we have started implementing GAR now. It is right currently being implemented in India. Done? Can we go forward now? Anybody has an issue? Can we go forward? Please do let me know. Okay, some of you are asking questions about SCZ. Do not worry about SCZ policy. We'll discuss that in detail. Right now, simply understand, Government of India will notify certain regions as special economic zones because government wants from these zones the goods or services to be exported. Very simple. From these zones, the goods and services should be exported. That is the reason government will identify SEZ areas. Now, many companies might misuse, and again, please understand, many of you are saying, is GAR applicable only to SEZ? Not necessary. That was one example to make you understand. That was one example to make you understand. In the same way, you can enter into multiple arrangements. Even if you're outside SEZ, you can enter into multiple arrangements in order to avoid taxes. All of them will be brought under the GAR purview. All of them will be brought under general anti-avoidance rules. Okay, done. Again, do not worry about SEC policy. Again, I'm repeating, we'll take it up in detail when I take up investment. When I take up investment policies, I'll take it up in detail. Don't worry. Okay, what is the meaning of substance over the form? What is the reason why you have entered into an agreement? Or what is the reason why A and B have entered into an arrangement? What is the actual reason? We are worried about the substance of the arrangement, not the form of the arrangement. Form of the arrangement is what? A will purchase it from B, export it. And A, because it is present in SEC, will pay 0% tax, and B will pay as usual 30. That is form of the arrangement. We are not worried about form of the arrangement. We are worried about substance. Why the arrangement has been made in the first place. Is it going to add anything commercially to the economy? Is it going to add value to the economy? Or it has been entered just to avoid taxes? Right? That is commercial substance. Okay. Will exports from SEC attract taxes? My dear, you tell me. You tell me. Do you want to impose taxes on exports if you want to promote more exports from India? I'll repeat the statement. You want to promote exports, will you impose the taxes on exports if your objective is to promote exports? No. No, I hope you understand. Absolutely no. Why? If you impose the taxes on exports and on the other hand you want to promote exports, your exports will become more costlier. They will start losing competitiveness in the international market. So generally, please remember this, generally on exports, we do not impose taxes until and unless there is a particular reason behind it. For example, many of you will throw one example at me, sir, but government is imposing taxes on wheat, rice, etc. Does government, is the government imposing taxes to promote export or reduce export? Please think of it. It is to reduce exports so that exports will come down, domestic supply will increase, and market prices will come down. So objective is important here. Okay, done. So next concept is GST. Next idea is GST, goods and services tax. We'll take it up after the break. Before the break, if there are any questions, please do let me know. Let me address the questions. Sir, MAT also helps in BEPS prevention. So MAT part of BEPS action plan? No, my dear. MAT is applicable to the companies which are generating incomes and claiming deductions within India, right? And BEPS is applicable to the companies which are shifting profits outside India, right? So the purview of coverage is different. When we say capital gains, what is the relation it has with capital in four factors? My dear, the term capital there generally refers to the machineries, assets that we have created. Capital gains talks about purchasing certain assets, selling the assets again, selling the assets at a higher price. So on that case, the capital gains is applicable. Okay. Not clear difference between dumping and countervailing. My goodness. Again, I'll repeat it. I don't know how many times I'll have to repeat it. I think I've told this 3 times yesterday. Dumping means you are not getting any subsidy, you are exporting to rest of the countries at 100, you will export to India at 95. You are dumping, suppressing the price and increasing exports to India. That is dumping. Countervailing means I will get subsidies from the government. As a result of that, the price will come down. My export prices will come down. I'm not suppressing. My prices have come down because of subsidies, right? In that case, government of India will impose countervailing. Both are different. I don't understand what is the difficulty. In one case, you are artificially suppressing the prices. In another case, you are getting subsidies, hence the prices will come down. Don't you think both are different? And what is the difficulty? I don't know. Okay, explain pillar 2. I'll repeat it. In case of pillar 2, the companies, imagine they are paying taxes in any country, right? Let's say they might be paying taxes in Mauritius, They might be paying taxes on their profits in Netherlands, Switzerland, or any country for that matter. If the corporate tax applicable in that country is less than 15%, then the difference will be calculated. That amount of tax rate will be collected by the home country. Home country means the country where the company started. That country will impose and collect the difference in the corporate taxes. Okay, done. Let me take a break now. After the break, we'll start with GST. We'll restart the discussion at 8:05 a.m. Please join back at 8:05. Okay, welcome back. Am I audible? Please do let me know. Am I audible? Can we start? Okay, let's start. Next concept, very important, slightly technical, but very, very important idea of a GST, goods and services tax. Now, to understand what is this goods and services tax, let me explain certain important background concepts to that. Then we'll shift to GST. Now, there are two very important ideas. One is a cascading effect. Second one, second one, the idea of a input tax credit. Okay, idea of input tax credit as well as cascading effect. Cascading effect simply means tax on tax. Cascading effect simply means tax on tax. Now, what is this cascading effect? Let me explain. Again, don't run behind calculations. Many of you will be stuck with calculations only. Calculations are not important. Understand the concept behind it. A will manufacture a product, sell it to B. B will manufacture, use it as an intermediary good, sell the final product to C. A will sell it at, let's say, 100 rupees, and government has imposed a tax of 10%. B will purchase the product at 100 plus 10, 110, 100 plus 10, 110, and B will use a labor, right? Let's say profit motive, etc. Now B wants to sell it at 130 rupees. Now again, the government will impose a tax of 10%. Now please look at this 130 rupees. Can I say we get 130 rupees by including intermediary good 100 plus 10 rupee, which is already the tax that B has paid, plus 20 rupee labor cost, profit, etc. for company B. Now let me know, if I impose a 10% tax on 130 rupees, can I call it as tax on a tax? Please look at the board and let me know. If I'm imposing 10% tax on 130, and how do I get 130? 100 plus 10 plus 20. And 10 rupee is the tax that I've paid already, yeah, assuming I'm the company B. So if I impose a 10% on 130 rupees, can I call it as tax on tax? Anybody has difficulty here? Right? This is important. Anybody has difficulty? So because there is a tax imposed on a tax, this is called as a cascading effect. This is called as cascading effect. And what is the problem? What is the issue with cascading effect? If there is a cascading effect in the system, point number one, can I say market price of the product will be higher? Correct? Market price of the product will become higher. Point number two, the tax burden on the customer. The tax burden on the customer will also be very high. For example, look at this. Look at this calculation. When customer will pay 143 rupees, when the customer pays 143 rupees, can I say the tax burden on the customer is 10 rupees from step number 1, 10 rupees from step number 1, and another 13 rupees from the step number 2. So the total tax burden on the customer in this example is 23 rupees. And why is it 23? Because there's a cascading effect. Existing tax is being imposed with one more tax. That is cascading. So with cascading effect, market price will increase and the tax burden on the customer will also keep on increasing. That is point number one. Point number two, earlier, please understand this very carefully. Earlier, central government used to impose excise duties on production. Earlier, central government used to impose excise duties on production, and state governments used to impose a sales tax on sales of the goods. On the sales of the goods. All of you okay with the production tax and sales tax? For example, you manufacture this marker. Central government will impose excise. I will purchase the marker and I'm a retailer, I'm a distributor. I will sell it to somebody else. State government would impose a sales tax. State government would simply impose sales tax. And because central government, right, imposed tax, collected tax. State government also imposed tax, collected tax. There was a cascading effect. There was a cascading effect in the system. Now, to address cascading effect to a certain extent, state governments, I repeat, state governments introduce the concept of VAT. State governments introduce the concept of VAT. What is VAT? VAT means, I've written it here, value added tax. VAT is nothing but value added tax. Now, how the VAT will work out, let me show it to you. Please look at the example now. Let me show how VAT will work out. Let's say A will sell a product to B, B will sell it to customer. A will sell it to B, B will sell it to customer. Now A will sell it at 100 rupees to B. A will sell it at 100 rupees to B, and let's say will impose a tax of 10%. Will impose a tax of 10%, which means B will pay 100 rupees for the product plus 10 rupee tax for the product, purchase it at 110. Now B will transport it, B will incur certain marketing expenses, etc. He wants to make a profit of 20 rupees. So now B wants to sell it at 100 plus 10 plus 20 rupee profit in the market. But now under VAT system, I repeat, now under VAT system, government will tell me, assuming I'm B, government will tell me whatever taxes you have paid on your input, whatever taxes you have paid on your input will be credited back to you, will be given back to you. Is it okay? I'll repeat it again. Under VAT system, government will tell me whatever taxes I've paid on the inputs, that is 10 rupee, this tax on the input will be credited back, will be given back to me. Now, because I'm getting this 10 rupee back, the tax I'm getting it back, when I want to sell the product in the market, I will not include the 10 rupee in the market price. Is it okay? Because I'm getting this particular 10 rupee tax that I've paid on the input, I will get it back. Because I'm getting the credit of it, I will not include the 10 rupee when I decide the selling price of the product to the customer, which will bring the selling price to 120 rupees. Now government will impose, let's say, tax on 10% tax on 120, which will become 12 rupee. C will buy it at 132 rupees. That is 120 rupees plus 10% of it is 12 rupee, 132 rupees. Now, simple question to all of you. Please look at the calculations and do let me know, is there a cascading effect in this example? I'll repeat it. I'll repeat the question. Please look at the example, look at the calculations and tell me, is there a cascading effect in this calculation? And as expected, some of the students are saying yes. How? Let me ask you the question now. How? Where do you see cascading effect? Are you seeing a cascading effect in the step 1 or a step 2? Please do let me know. Those who are saying, yes, sir, there's a cascading effect. There is a tax on existing tax. Tell me, where are you seeing cascading effect? Step number 1, is there a cascading effect? Are we imposing tax on the tax? No, we are not imposing tax on tax in the step 1. In the step 2, right? And as expected, some of you are saying, sir, in step 2, there is a cascading effect. My dear, 120 rupees. Please tell me, selling price is 120 rupees. Out of 120 rupees, 100 rupees input cost, 100 rupees input cost, 20 rupees profit. Correct? 100 rupees input cost, 20 rupees, right, profit. If I impose 10% on 120, where is a tax on tax here? Tell me. Let me know. Right? Those who are saying, yes, in step 2, there is a tax on tax. I'm imposing 10% tax. I'm imposing 10% tax on 120. In 120, 100 rupee is raw material cost or product cost. And 20 rupees is the profit. Where is the tax on tax? There is no tax on tax here. Those who are wondering, there is no tax on tax, my dear. It's not difficult. Is there a tax on which I'm imposing tax? Let me know. Right? Anybody, please do let me know who has a difficulty now. Is there a tax in this example on which I'm imposing tax? That is called as cascading. There is no situation that is existing here. In step 1, only one tax is there. In step 2, 120, and within 120 there is no tax. 100 is a raw material cost or product cost plus, right, the 20 rupees profit motive. Right, so 120, and on this 10%, 132 rupees. There is no cascading effect. And those, there are some students who are saying, where has the 10 rupee vanished? Where has the 10 rupee gone? Please listen to me. You are not listening to me. I don't know what is the problem. You are not listening to me. Did you listen when I say, I've paid, assuming I'm B, I've paid a 10 rupee tax on my input. Government will give it back to me. Did I say this or not? And why? What is the problem? Why are you not receiving? Why are you not listening? I don't know why. Right? So I've paid 10 rupee tax on my input. Government will give it back to me. And because government is giving the 10 rupee back, I will not include that in the selling price. Right? So that is input to tax credit. I'll repeat it. The 10 rupee taxes that I've paid on my input will be credited back to me, will be given back to me. This is called as input to tax credit. Now, please tell me, can I simply say, by providing input to tax credit in this system, under the VAT system, we will be able to eliminate cascading effect? Let me know. Right, under this system, under the VAT system, by providing input tax credit, we'll be able to eliminate cascading effect. Right, and if you look at it, again, I'll show you the calculation, not needed. If you look at it, it's a very, very beautiful concept. Very beautiful concept. Although flaws are there, I'll come to the flaws later. How can we ensure that there is no tax on tax? Right? How can you ensure that there is absolutely no tax on tax? Listen to me now carefully. I'll not repeat this. Listen to me carefully. How much is the total value addition done in this example to the economy? How much is, in this example, how much is the total value addition done to the economy? Total value addition done, total. Do you understand the term total? Right, in the step 1, forget, I'll show you the calculation. You people are making mistake. Value addition, my dear. Right, in value addition, step 1, how much is the value addition done here? 100 rupee. I'll show the calculation. Don't worry, you're making mistake. Don't worry, leave it. Tell me if there is a doubt after I show you calculation. Step 1, value addition done is 100 rupee. Correct? Step 2, right? Although I'm selling it at 120, out of that, intermediary good is 100 rupee. So can I say value addition done in the step 2 will be 20 rupee? Any problem? Let me know. Any problem? Step 1, value addition is 100. Again, tax is not counted. Value addition, I'm talking about value addition. Tax will come later. Step 2, total selling price is 120. But out of that, 100 is intermediary good. So step 2, value addition will be 20. So can I say total value addition done in this system will be 120 rupees? Now, if you calculate 10% of 120, because the tax rate is 10%, if you calculate 10% of 120, can I say tax will become 12 rupee? Correct? Out of 120, if you calculate 10%, how much will be the tax collection? 12 rupee. Now, please tell me, step number 1, how much money, how much tax the government collected? Step number 1, how much tax government collected? 10 rupee. Step number 2, how much tax government collected? 12 rupee. So step number 1, 10 rupee. Step number 2, 12 rupee. But this 10 rupee is given back to me. It is returned back to me. So how much is effectively collected by the government? 12 rupee tax. Does it make sense now? Right? Don't you think by collecting 12 rupee in this example, we are ensuring that we are collecting taxes only on the value addition done in the economy. And if you're ensuring that taxes is on the only value addition, it simply means there is no cascading effect. It simply means there is absolutely no cascading effect. Right? So that is a basic idea. That's a basic idea. Okay. Then again, UPSC will not ask you to this extent, right? Can you prove how this is done, etc., etc. But just to make you understand this, why this VAT system is so beautiful, we are ensuring that cascade effect will be eliminated. But there's a flaw with this system. I'll come to that. So come to the next point here. Come to the next point here. So state governments, in order to address the issue of cascading effect, state governments introduced a VAT system. Right? State governments introduced VAT system. But even after introduction of VAT system, there was a problem. There was a flaw with the system. Right? Even after introduction of VAT, it led to cascading effect in the system. How so? Let me take one example. Listen carefully. This is state 1. This is state 1. Okay. And this is the state 2. I'll use a different, let's say, marker so that you understand. This is state 2. Okay. Please understand this. That is the example that I'm taking is interstate trade and commerce. Interstate trade and commerce means what? Production is happening in one state, consumption of the good is happening in another state. It is called as interstate trade and commerce. Now, certain points here. Whenever there is interstate trade and commerce, the right to impose a tax when the product will move from one state to another state is with the central government. Is it okay? Under Schedule 7. This is there under Constitution of India. Whenever the product will move from one state to another state, the right to impose a tax on this product is with the central government. And to do that, central government introduced a tax by the name of Central Sales Tax. Central Sales Tax, CST. But next point is important. Central Sales Tax, no doubt, was imposed by the central government, but the tax was collected and utilized by the state where the product originated. I'll repeat the statement. Listen carefully. CST was under the central government, no doubt. Central government had the power to impose CST. But the tax was collected and utilized by the state from where the product originated, from where the product was actually manufactured. Now, in this example, please tell me, if the product is manufactured in the state 1, crosses the border, enters into state 2, consumed in the state 2, which of the two states will get central sales tax? The product is manufactured in state 1, moves across the border, enters into state 2, consumed in the state 2. Can I say state 1, state government 1 will get central sales tax? All of you okay? Now let's start. Right? Imagine I'm a seller in B. I'm present in the state B. Okay? I'm present in state B. I will purchase a good from another company, company A. Company A is present in another state. Right? Just to make it easier, I'll take names of the states. Don't panic. Right? Don't panic. Don't worry about it. Let's say state 1 is Uttar Pradesh and state 2 is Bihar. Okay, state 1 is UP and state 2 is Bihar. The product is manufactured in UP, crosses the border into Bihar, central sales tax of 10 rupee, assuming the price of the product is 100, the central sales tax of 10%, that will be 10 rupee, will be collected and utilized by the UP government. Now I am sitting in Bihar. I will purchase the product at 100 plus 10. And because I am present in Bihar, I am there in Bihar, I am registered with the Bihar government. Under the VAT system, I'm registered with the Bihar government. Now, please understand this. Although I have paid a tax of 10 rupees CST that goes to the UP government will not give me input tax credit. UP government will not give me input tax credit. Why? Answer is I'm not registered under the VAT system with UP government. I'm registered in Bihar. Because the UP government has collected CST, they will not give it to me. They will not give the credit of 10 rupee to me. Now, because I'm not getting a credit of 10 rupee, what I will do? I've purchased the product at 100 rupee plus 10 rupees central sales tax is there. I'm also transporting, I'm also using labor. I want to earn profit. Let's say that will take the number to 20 rupees, additional 20 rupees. So now what I will do, if I get the 10 rupees ITC, I will not include 10 rupees CST in deciding selling price. But because I'm registered in Bihar, not in UP, I will not get 10 rupee ITC. So what I will do, in deciding the selling price, I will add 100 plus 10 plus 20, my selling price will become 130. And now Bihar government also has a VAT. So what the Bihar government will do? They will impose a 10% VAT on the selling price. 10% on 130 will take the price to 143. But can I say there is a cascading effect because of CST? Look at it. Now look at the example. Because of this, can I say there's a cascading effect because of central sales tax? Right? So understand this. Bihar government will have their own VAT system. UP government will have their own VAT system. Right? Let's say Chhattisgarh government, right? Or Assam government, Karnataka government, Andhra Pradesh government, all of them will have their own VAT system. But these VAT systems are applicable within the state. It is applicable within the state. If the product will move from one state to another state, automatically CST becomes applicable. And if the CST becomes applicable, it will go to the state where the product is manufactured. But if the seller is sitting in the second state, he will not get ITC. That will lead to cascading effect. Can we go forward then? Can we go forward? So please do let me know. Even after introduction of VAT systems by the states, can I say because of interstate sales, interstate trade and commerce, there was a cascading effect in the system. Right? Because of a CST, there was a cascading effect in the system. Okay? Right? So that is the reason now, please have a look at it. Now, Government of India says, we will eliminate the cascading effect. We will remove the cascading effect. Right? Even though VAT is there, we are not able to eliminate, etc. What we will do is, we will introduce a new system called as GST. We'll introduce a new system called as GST, Goods and Services Tax. Under the Goods and Services Tax, objectives are: one, we will eliminate cascading effect. You will understand in some time, have patience. There are multiple indirect taxes now. Central government has multiple indirect taxes. State governments have multiple indirect taxes. And the system becomes much more complicated by the fact that the same indirect tax rate will be different from one state to another state. For example, the VAT value added tax for this marker in state 1 could be 12%. In another state could be 14%. Third state could be 9%. So the system is so complicated that one, center has multiple indirect taxes, state has multiple indirect taxes. But within the states, same product will attract different rate in different states. That's a very complicated taxation system. Very, very complicated. Now we will address it. We will also widen the tax base. More and more taxpayers, companies, sellers will be brought under taxation. That is under GST. Now please tell me, do you understand the term widening of the tax base? If more products are brought under GST, If more companies, sellers are brought under GST, can I say tax base will become wider? And if the tax base will become wider, automatically the tax revenues collected by the government are expected to increase. So to widen tax base and increase the tax revenue, the transportation cost are adding a lot to the market prices. We will address the transportation cost issue. Now, what is this transportation cost? Let me explain it. Listen carefully. Now, there is a term called as logistics. Very recently, it was there in the newspapers. I don't know how many of you have read it. Very recently, the term logistics was there in the newspaper. Now, what do you mean by logistics? Logistics simply means the various activities that we will undertake to move a product from point A to point B. I'll repeat the statement. Various activities that we will undertake to move the product from point A to point B, it is called as logistics. For example, right, what kind of activities we will undertake to move a product? Can I say packaging? Correct? We will package the product. We will transport the product. We will warehouse or store the product. Can I say these are different types of activities which are undertaken? I repeat, these are different types of activities which are undertaken to move a product from point A to point B. Collectively, this is called as logistics. Collectively, this is called as logistics. Now, please remember certain important current affairs points. Traditionally, in case of India, one of the reasons why the market price of products in India is higher, why our export competitiveness is lower, is because of higher logistics cost. I'll repeat the statement. Traditionally, one of the reasons that is cited as to why our market price is higher and our export competitiveness is lesser is higher logistics cost. Government of India until very recently said that the cost of logistics in case of India is in the range of 13 to 14 percentage of GDP. It is in the range of 13 to 14 percentage of GDP, which means if I'm having a GDP market price of 100 rupee, out of that 13 to 14 rupees because of logistics cost. And if you compare this with other countries such as China, such as USA, for them the cost of logistics generally is in the range of 6 to 8 percentage of GDP. 6 to 8 percentage of GDP. So government of India already is taking lot of measures to reduce the cost of logistics. And very recently there was a report which was published which says cost of logistics in case of India is not in the range of 13 to 14%. It is somewhere in the range of 8 to 9%. Please check. It was there in Hindu newspaper, many other newspapers as well. Cost of logistics, in fact, it was there last week only. Cost of logistics in India is not 13 to 14%. In fact, it is in the range of 8 to 9%. This is the discussion in the current affairs regarding logistics. Now come back to taxation here. What is the problem with the cost of transportation under the earlier taxation system? Please look at the government data. Government data says that out of the total time taken for transportation, around 25% of the time is spent at the check post. What do you mean by check post? Imagine you're crossing from one state to another state. You're crossing the border from one state to another state. At the border, there will be a checkpoint where government officials will be sitting. You'll have to stop your truck, take all your documents, go to government officials, show all the documents to government officials. Sometimes, again, don't write this in the exam. Sometimes pay bribe also. Now they will allow you to enter from one state to another state. This is a concept of a check post. Earlier, check post became a problem. Why? 25% of the total transportation time was spent at the check post itself. So government of India now says under GST, I repeat, under GST, We will eliminate the concept of check post altogether. I'll repeat the statement. Listen to me carefully. Under GST, we will eliminate the concept of check post altogether, which means now can I simply say, if I move from one state to another state, now the time taken for transportation will become lesser. Think of it. Now, because of elimination of the check post concept, the time taken for transportation will become lesser. I can travel more distances to transport goods and services. So if the time taken will come down, cost of transportation will come down, cost of logistics automatically will come down. Will it not provide benefit for manufacturing activities in India? Correct? Will it not provide benefit for the manufacturing activities in India? Right? So that is how we say that GST will reduce the cost of transportation, and it will also promote business activities, promote manufacturing activities. It will make it easier to conduct business in India. Okay, so that is the concept of goods and services tax. These are the reasons, these are the objectives why GST has been implemented. Can we go forward? Okay, now what are the features of GST? What are features of GST? What are the various features of GST? Let's start one by one. First one, under GST, we want to streamline indirect taxes. Instead of having multiple indirect taxes, we want to have only one indirect tax for the whole of India. That is the reason the central theme of GST is one nation, one indirect tax, one national market. Remember this: one nation, one tax, one national market. Right? One nation, one tax is very simple because we are subsuming. Subsuming means bringing all of them under GST. Instead of having separate service tax, it will be part of GST. Instead of having a separate VAT, it will be part of GST. So we are subsuming all these indirect taxes under only one tax. Now, why it is called as one national market? This pen or this marker, whether it is sold in Karnataka, Tamil Nadu, UP, Bihar, Chhattisgarh, Assam, Punjab, doesn't matter. The rate of GST will remain same. All of you okay with this? The rate of GST, right? The rate of GST will remain same, right? Imagine the GST rate is 12%. So throughout India, the GST rate on the marker will remain same 12%. So the under the GST, the central theme is one nation, one indirect tax, one national market. Second, we are taking away the taxation powers. We are taking the taxation powers of the states, bringing it under GST. We are taking taxation power of the center, bringing under GST. This will require constitutional amendment. Why? The taxation powers are given or distributed to center and state under the Constitution of India, Schedule 7. Now, if you are changing the taxation powers, we had to make changes to the Constitution of India. So we amended the Constitution of India so as to bring the taxation powers of the center and the state under GST. Point number 3. We also amended Article 279, that is introduced Article 279A, under which we have set up a constitutional authority, GST Council. We have set up the constitutional authority, GST Council. Now, the GST Council is the most important authority in regards to implementation of GST. How so? The GST Council will have a composition of central government representation as well as states representation. And apart from the states, union territories which have legislative assemblies. I'll repeat the statement. UTs which have legislative assemblies will also have a representation. So the GST Council will take decisions regarding GST, whether to bring any product under GST, what rate should be applicable for this product. Should we increase the rate of GST? Should we reduce the rate of GST? Should we exclude some of the product out of GST? All of these decisions are taken by the GST Council. So under Article 279, President of India has constituted GST Council. The chairperson of the GST Council is the Union Finance Minister. Union Finance Minister is the chairperson. Okay. So what are the functions? We have discussed this. Apart from this, I'll come back to this, don't worry. Apart from this, whenever the GST Council will convene means have a discussion, deliberations, etc. They will make decisions. They will take decisions regarding GST. Whenever the GST Council wants to take decisions, the decisions are taken with at least 75% of present and voting majority. At least 75% of the votes have to be there in favor of a particular thing. Only then GST Council can take a decision. Now, how the votes are divided? How the votes are divided? 1/3 of the votes, that is 33% votes, have been given to center. 33.333, again you can talk in that way. Remaining 2/3 of the votes have been equally divided. I repeat, remaining 2/3 of the votes have been equally divided between all the other states as well as union territories. Which means whether you are a bigger state, smaller state, doesn't matter, right? Same equal weightage of vote will be allocated to you. And please understand, when you say 75%, minimum 75% has to be in a favor. Can I say central government has a veto power in the GST Council decision making? Let me know. Look at the data and tell me. At GST Council decision making, the center has effective veto power. Veto power means imagine all the states plus union territories want to increase the GST rate. If the center says no, I will vote against it. If the center says no, I will vote against it, which means central government, by controlling 33%, others will not be able to get 75%. Is it okay? Center has 33%, which means even if everybody comes together, everybody else in the GST Council comes together, they will not be able to get 75%. Mathematically impossible, right? Nothing difficult here. Mathematically impossible, because out of 100%, if you take out 33, left out is 67. You need 75%, right? So I hope you understand. Center has veto power, right? That is a criticism, in fact. And former finance minister Mr. P. Chidambaram criticized the central government model, saying that, again GST model, saying that center has effectively the veto power in the GST Council. States, whatever they want to do, center has to accept it, center has to support it. Until and unless central government agrees, nothing can be done in the GST Council. Okay, so quorum requirement is 50%. What do you mean by quorum requirement? What should be the total number of members present so that the discussions can be started? What should be the minimum present number, right? How many members should be present, minimum number, so that the discussion can be started? That is called as quorum. In GST Council, quorum requirement is 50%. Okay, so these are certain features regarding the GST. Now, couple of more features. One, please remember this. Under GST, can I say trade can happen for a good intrastate as well as interstate? Please do let me know. The trading of goods and services can happen between two states, between three states, interstate or intrastate. Beyond that, there is no possibility, whether it is between the states or within the state itself. Whenever it is intrastate, we simply say GST, and whenever it is among the states or between the states, we use the term integrated GST. Integrated GST. Anybody has a problem? Let me know right now. When it is within the state, production, consumption happens in the same state, GST. When production happens in one state, consumption happens somewhere else, that is out of the state, we apply integrated GST. Now please understand, whether it is GST rate or integrated GST rate, rate is always same. That is, If this pen is manufactured in Bihar, consumed in Bihar, let's say GST rate is 12%. If it is manufactured in Bihar, consumed in UP, GST rate will still remain 12% only. Rate does not change. But when I say integrated GST or IGST, it simply means it is not within the same state, it is between the states. It is interstate, right? So that is a basic idea. That's a basic idea. Okay, now whether you talk about integrated or GST, we follow a dual GST model. We follow a dual GST. Dual GST means two components. What is this dual GST? Whenever you write GST or IGST, there are two components. One is called as central GST and the second one is called as state GST. That is, they will write it as CGST and SGST. They'll write it as CGST and SGST. Now, what is the CGST? CGST is the tax, right? Tax component within GST, which will be taken by the central government, which will go to central government. And if I write SGST, the SGST tax component will go to the state where consumption happens. Listen to me very carefully. SGST is a GST component, the other half of the GST component, which will go to the state where consumption happens. Can I say this is exactly opposite to the central sales tax? Please think of it. I'll repeat it again. SGST is the state GST component which will go to the state where consumption happens. Can I say this is opposite to what was proposed under central sales tax? In case of central sales tax, CST, it will go to the state where production happens. Where production happens. Whereas in GST, that is SGST, it will go to the state where consumption happens. Consumption happens. That is the reason, please remember this. CST is referred to as origin-based tax. It is referred to as origin-based tax. Whereas a GST is referred to as destination-based tax. Destination-based tax. Destination-based tax. Anybody has a problem with this? Anybody has a problem with this? What about VAT? Please tell me, what about VAT? VAT is also destination-based tax. Right? VAT is also destination-based tax. Right? Those who are having doubt, please listen to me carefully. VAT is imposed on sales, not on production. VAT is imposed on sales. VAT is imposed and collected by the state whenever the sale of the good happens. So sale of the good, let's say to the customer will happen, the state government will collect the VAT. Can I say destination-based taxation? And those are asking what is CST? Central sales tax. My goodness. How easily you people forget. How easily you people tend to forget. Central sales tax, CST. So is the concept okay? So far so good? Under GST, we have a destination-based taxation system. Under CST, earlier taxation, we had origin-based taxation system. Okay? Right? So we have a dual GST model, CGST, SGST. CGST will go to the center. SGST will go to the state where consumption happens. Now, how much is CST? How much is CGST? How much is SGST out of GST rate? Always remember this. Whatever the GST rate is applicable, whatever GST rates are applicable, the GST rates are equally divided into CGST and SGST. I'll repeat the statement. Whatever is the GST rate applicable, it is equally divided into two parts, CGST and SGST. For example, if I say GST rate is 5%, it will equally be divided into 2.5 and 2.5. If I say GST is 12%, 6%, 6%. If I say GST is 18%, 9% and 9%. If I say GST of 28%, 14% and 14%. One component of 14, assuming it is 28, one component will become CGST, another component will become SGST. And the SGST will always go to the state where consumption happens. Okay, right? So this is basically the idea of right, the features, or let's say the slabs or the dual GST model that we follow. Certain goods even today are exempted. Certain goods even today are exempted. These are not having any kind of coverage under the GST law. For example, alcohol for human consumption. Even today, alcohol that is produced in India for human consumption, the taxation is decided by the state governments. The taxation is decided by the state governments. Taxation is decided by the state governments. Done? Right? If you are still having a doubt, please tell me. All of you are reading regarding Delhi liquor policy. Think of it. Delhi liquor policy, it is there in the current affairs. Right? So I hope you understand. I hope you understand, right? The goods, alcohol that is produced in India for human consumption, even today it is taxable by the state governments. What about alcohol that is imported into India? Think logically. Alcohol that is imported into India, will the state government have the power or center have the power to tax? Think logically, always think logically. If anything is imported into India, will the center have the power or state have the power to impose taxes? Center. My dear center, you people tell me that polity is already over for you. The customs powers, don't you think it is already there with the center? If anything is imported, customs is applicable and customs is under the central government. And it's a basic idea, Under polity, you have discussed all of it. You need to apply it now. Okay. So, alcoholic liquor for human consumption, electricity tax, etc. Even today, they are not covered under the GST law. They are not covered under the GST law. What about fuel products? What about fuel products? Petrol, diesel, aviation turbine fuel, etc. They are covered under the GST law. I repeat, they are covered under the GST law. But even today, we have not announced GST rate for fuel products. Can we go forward? I'll repeat it again. The GST law covers fuel products. It is mentioned in the GST Act. But even today, we have not announced the rate of GST for fuel products. It's not easy to announce. Okay. So GST Council to decide when to impose the GST rate on crude petroleum, diesel, petrol, ATF, etc. And finally, compensation period of 5 years. This is there in the current affairs. Please be very careful. Please be very careful. Compensation was given to the states for 5 years. Now, question is, what is this compensation? What is the idea of a compensation? Let me explain this. Listen to me very carefully. Now, the idea of a compensation was introduced before the introduction of GST. Before we introduced GST, there was a lot of discussion by the states, concerns raised by the states. What is a concern? Let's say right now, you are the chief minister of the state. Okay, 853, congratulations, you're a chief minister. Okay. Now, let's say before GST, 2017, please understand, 1st July 2017, GST was implemented in India. Before GST was implemented, let's say 2013, 2014, you're talking about that, you have the right to decide what is the VAT rate on this marker. Correct? I'll repeat the statement. 2013, 2014, you have the right to decide what will be the VAT rate on this marker according to your requirement, whether you want to earn more tax revenues or less tax revenues. According to your requirement, state government, that is a chief minister, can change the VAT rate on the marker. Now imagine GST has been introduced, this marker or the pen has been brought under GST. Now tell me, can you individually, as a chief minister, single chief minister, can you decide to increase the GST rate on the marker? Think of it, right? Can you decide to reduce the GST rate on the marker? No, not at all possible. Why? GST Council will decide now. You will not decide, right? GST Council will decide. So don't you think state governments will be concerned about the fact that they are giving away the taxation powers to GST Council? What if in later years, after 1 year, after 2 years, the amount of GST money they are getting, GST revenue they are getting is lower than expected? Correct? Right? What if, right? They will end up earning lesser amount of GST revenues. At that point of time, you cannot decide to increase GST rate. It has to be decided by the GST Council. So to compensate for this, right? Basically, central government said, if that is your concern, if revenue is your concern, we will introduce a concept of revenue compensation. I'll tell you how revenue compensation was done. Listen carefully, slightly technical. How compensation was done, I'll tell you. Point number one, for 5 years, for 5 years, since the launch of GST, since the implementation of GST, the GST compensation was given by the center to the state. Point number one, 5 years. Now, based on this point, you tell me, is the 5 year period over as of now? Let me know. Right? We implemented GST from 1st July 2017. Is the 5 year duration over now? Yes. Right? June 2022. If you sit after the class, take out calendar and start counting. June 2022, 5 year duration is over, which means currently, as of now, as of today, center is not paying any compensation to the states, and that is one of the point of friction between center and states. One of the point of friction, why states are saying center should continue to provide compensation even today. They should extend compensation. They should extend compensation. Center is not paying compensation. Some of you are saying, right, sir, no, they are paying compensation. No, my dear, they have stopped paying compensation. I'll tell you the facts. Just wait. You're confused. Just give me a couple of minutes. Point number two. Sir, why? Why did we decide only for 5 years? Why not 15 years? Why not 50 years before implementation? Reasoning that was given by the government and accepted by the states. I repeat, reasoning that was given by the states, by the center and accepted by the states before 2017 was, initially for a couple of years, there'll be problem with the revenue under GST. Initially. But once GST stabilizes, don't you think it will contribute more to manufacturing activity? It will promote manufacturing activity. It will increase the competitiveness of Indian products, which means production will increase. The revenues that are earned by the states under GST in a longer period, maybe after 5 years, will be stable, will be higher. In fact, if you're reading newspapers, what is the monthly GST revenue collection today? Let me see. What is the average monthly GST revenue collection in the last couple of months? 1.6 lakh crore rupees. 1.6 lakh crore rupees. That is not a small amount. Compared to earlier, that is pre-GST, we have increased the revenue collection under GST. So the argument of Government of India and states also accepted this was that it might take 5 years for GST to stabilize. After that, don't worry, you'll be able to earn sufficient GST revenues. So that's the reason 5 year compensation was decided only for 5 years. Now next, how was the compensation calculated? How was the compensation calculated? This was the methodology. Please understand this. Whatever was your revenue collection before GST. For example, I'll take a simple number so that you understand. I'll take a simple number. Imagine by imposing VAT on this pen before GST, you were earning 100 crore rupees. Right? Before GST, 2015 and 16, because the GST came into force from 2017. So imagine in 2015 and 16, that was considered as a base year. In 15 and 16, imagine you earned VAT of 100 crore by imposing VAT on this pen. Now this pen has been brought under GST. So center assumed next year it will increase by 14%. Under GST, you will be able to earn 14% in addition to 100 crore rupees. So can I simply say, as per the formula, under GST, next year you are able to earn 114 crore rupees. You should be earning 114. This was called as expected revenue. This was called as expected revenue. But you please tell me, is there any guarantee that you will earn 114 crore under GST? Let me know. Think of it. Is there any guarantee that you will be earning 114 crore rupees? No guarantee. You might be earning more than 114 crore. In that case, nothing wrong. Take it. If you're earning more than 114 crore rupees, okay, good, you're earning more. But what if under GST you earned only 80 crore rupees? As a state government, you got only 80 crore rupees on this marker or this pen under GST. So now government said, right, whatever is the actual revenue collection, if the actual revenue collection under GST for a state is lesser than the expected revenue as per the formula, the difference between that 100% of it, 100% of this revenue loss will be paid in the form of compensation by the center. Is it okay? Is it okay? I'll repeat it again. Understand this. So far, no question has been asked by the UPSC regarding this. I'll repeat it. But even after that, if you do not listen, then it will become difficult for you. Point number one, government said, I will take away the VAT power that you have on this marker. I will put it under GST. Now you are concerned in 15 and 16, that is 1 year before GST, you collected 100 crore. If it is brought under GST, you might lose the revenue. So government said, don't worry. Whatever revenue you earned from taxing this product in 15 and 16, I'll take it as a base and I'll assume that under GST, next year, your revenues will increase by 14%. The number 14% is fixed every year like this. It will keep on increasing by 14%. But if you end up earning less than this expected revenue as per the formula, if you end up earning less than 114 crore rupees, then the difference between that will be paid by the government in the form of compensation. And this was given only for 5 years. Now we have stopped compensation altogether. But please understand the next point as well. During pandemic, what happened was the sale of the goods and services went down. Correct? The sale of goods and services went down. And if the sale of goods and services will go down, what do you think will happen to GST collection? Follow the sequence. What do you think will happen to GST collection of the states? GST collection of the states also went down. And if you look at the formula, 14%, in fact, there was a committee that was set up. There was a lot of discussion and later we decided, okay, let's keep it at 14%. Although there's a criticism, 14% is too high, much higher than the GDP growth rate, right? Although there was agreement between center and state, okay, after a lot of deliberation, it will be 14%. Even that was criticized, saying that 14% revenue increase is very, very ambitious, very, very high. But anyways, we have implemented it now. It's already done and dusted. Now tell me, on one side, the GDP has gone down, sale has gone down, automatically GST collection will go down. On the other side, if you apply the formula, don't you think the revenue, expected revenue will keep on increasing, but the GST collection because of the pandemic has gone down. So don't you think that's a problem for the center now, because the compensation is very, very high? Correct? Compensation that is supposed to be paid by the center is very, very high now. Now, next important point. How did government get the money to pay for compensation? In the first place, from where did the government get the money to pay for compensation? Understand this. You know the highest rate of GST. Now, at least after looking at the slab, highest rate of GST is 28%. Now, within 28%, there are certain commodities such as aerated drinks, such as tobacco products, right, etc., cars, etc., which will attract 28% GST. In addition, I repeat, in addition to 28% GST, these products also have to pay GST compensation cess. In addition to 28%, these sales of the products, they will also attract a GST compensation cess. So the center imposed GST compensation cess, collected money, used the money to pay for compensation to the states. Now the problem during pandemic was, I'll take numbers so that you understand. Imagine because of the pandemic, the revenue loss expanded, let's say, to 150 crore rupees. The revenue loss expanded to 150 crore, and compensation cess collection is just 70 crore rupees. Think of it. Center is imposing and collecting compensation cess so that they can pay compensation to the states for having incurred revenue losses. But the revenue losses are higher than the compensation cess collected. So do you think government has sufficient compensation cess to pay for compensation? Answer is no. Right? Answer is simply no. So what did government of India do? What did government of India do? They basically borrowed money. Is it okay? They basically borrowed money to pay for compensation to the states. Now, because they have borrowed money, they will have to repay it now. Because they have borrowed, they will have to repay it. That is the precise reason. Even though we have stopped paying compensation to the states, even today, that is till 2026, government will continue to collect GST compensation cess. All of you okay with this? Government borrowed because the compensation was very high, cess collection was low, right? So they borrowed money. Now somebody has to repay this money. We have stopped paying compensation, but we are continuously collecting compensation cess. Why? Because to repay this borrowing, we have decided we will continue to impose and collect GST compensation cess. Right? So these are certain very important current affairs points. Please be very, very careful. Please be very, very careful. Right? Suddenly UPSC can confuse you using the questions. For example, can I say this kind of question is very confusing? Statement 1, government is imposing, right, in financial year, let's say 24, government is imposing GST compensation cess and collecting amount of taxes. Statement 2, this cess which has been collected is being used by the government to pay for compensation to the states. You feel both the statements are correct. You feel both the statements are correct. In fact, you will feel statement 1 is the explanation for the statement 2. But answer is no. Statement 1 is correct. Statement 2 is incorrect. Is it okay? Statement 1 is correct. Statement 2 is incorrect. Right? And if you have followed or if you have seen the questions which the UPSC is asking, especially in this year UPSC prelims, these kind of questions have become favorites now. Statement 1, statement 2. Then he'll start playing with you. Both the statements are correct. Statement 1 is an explanation of a statement 2. Both the statements are correct, but statement 1 is not explanation of a statement 2. Both the statements are, statement 1 is correct, statement 2 is wrong. Statement 1 is wrong, statement 2 is correct. If you have not yet seen these kind of questions, these are difficult questions. These are difficult questions because You not only have to understand what the statements mean, you'll also have to understand whether they are explaining each other. That is the reason. I hope you understand. That is the reason. Please be very, very careful with these kind of concepts. So all of you okay with the GST compensation, sirs? Okay. Now, right, I told you, I'll come back to this slide. Nothing much in this slide. It is basically information, factual information. What kind of taxes from the center as well as the state government have been brought under GST? Subsume means brought under GST. I have given you certain examples of state government taxes, central government taxes. Now, some of you will take up, let's say, additional customs duty, and you'll start reading completely about additional customs duty. Not needed. Some of you will take, right, let's say, octroi and entry tax. You will start doing thesis on octroi and entry tax. Not needed. Why? There are more than 40 types of taxes and cesses which are brought under GST. Do you think you need to read about these 40 types of taxes now? Not needed. Why? They do not have any independent implementation. They do not have any independent idea now, right? All of them are part of GST, so focus on GST. Okay, right? So this is some more information regarding goods and services tax. Now, right, I'll come back to this. Let me show you. Right, let me show you a picture. I'll go back to previous slides. Don't worry. Let me show you a picture and prove to you how GST is better than earlier taxation system. How GST is better than earlier taxation system. Right? Understand? I'll give you two examples. One is interstate transaction. Another one is intra-state transaction. You do not have to by heart the calculation, but you need to understand how GST is beneficial for us. Let's start. First one is intrastate. First one is intrastate. Intra means within the same state. And please remember this. Service tax earlier was imposed and collected by the central government. I repeat, service tax earlier was imposed and collected by the central government, and VAT or sales tax was imposed and collected by the state government. So two different governments, and because there are two different governments, they will not give you input tax credit. Let's start. Pre-GST. Imagine the price of a product is 100 rupee and there is a transportation involved, right? Let's say cost of transportation, certain services are added. So there is a service tax of, let's say, 10%. Right? Not 100,000 rupee. So service tax at 10% will become 100 rupee. So 1000 rupee is the price plus 100 rupee. Now the product price will become 1100 rupees. Now imagine this has been sold now. Now it is being sold to a customer. It is being sold to a customer. So because it is being sold to the customer, state government will impose a sales tax. Okay, now let's start. So cost price is 1100. Profit, right? I want to earn profit of 1000. So I will include 1000 rupee plus 100. I'll repeat, 1000 rupee plus 100. Why plus 100? I have paid this to central government, and now I will not get ITC because next tax I'm giving it to the state government. If I pay both of them to the central government, central will give me ITC. If I pay both of them to the state government, state will give me ITC. But one tax, I've given it to center, state will not give me ITC. So what will I do? 1100 rupees plus profit of 1000. I want to sell it at 2100. Now the state government will impose a tax of 10%, which will become 210. So the selling price will be 2310 rupees. So now tell me, pre-GST, can you see cascading effect? Let me know. In pre-GST, can you see cascading effect? Come to the GST. This is important. This is important. Come to GST. Same. Price will be 1000. GST, let's say 10% will become 100 rupee. So step one, I've purchased something. I've paid a GST of 100 rupee. So for me, I've paid 1000 plus 100. Now step 2, I want to sell it to a customer. I want to sell it to a customer. Now whatever 100 rupee GST I've paid in the step 1, government has told me they will give it back to me in the form of input tax credit. Government has told me they will give it back to me. 100 rupees will be returned back to me. So because I'm getting 100 rupee credit back, I'm getting the 100 rupee back, I will not include 100 rupee in the selling price. So have a look at this. Cost price will become 1000 rupee because I'm not including 100 rupee GST plus profit of 1000 rupee. My selling price will become 2000. Again the GST of 10%, 200 rupee. My selling price MRP will be 2200. Now, please tell me, question number 1, please tell me, is there any cascading effect under the GST system in this example? Is there any cascading effect under the GST in this example? There is no cascading effect. And let me show you how settlement of the transaction is done. How actually the settlement of the ITC is done. Step number 1, I've given 100 rupee to the government. I've given 100 rupee. They will credit it back to me. They will give it back to me. Right? So 100 rupee, whatever is collected, now they will give it back. Sir, how they will give it back? As expected. How they will give it back? All these manufacturers and sellers will have an account with the tax authorities. They will have account. They should have the account under GST. So that 100 rupee will get added as a credit in your GST account. Right? Now come to the step number 2. How much money has been collected by the government under GST in the step 2? 200 rupees. So can I simply say overall, that is after ITC, government under the GST system has collected 200 rupees. Government has collected GST of 200. Of course, 100 rupee they have given back. So they have collected 200. How this 200 will be distributed? Divided equally. Divided equally into two parts. 100 rupee will be CGST, will go to the central government. 100 rupee will be SGST because it is intrastate. Right? All of you understand intrastate? Anybody has a problem with the term intrastate? Because it is intrastate, automatically the 100 rupee will go to the same state government. Okay, so 100 SGST will go to the state government, 100 CGST will go to the central government. Can we go forward now? Right, second example, interstate. Second example, interstate. Now, is the pre-GST system okay with all of you? Earlier we have discussed this. Right, 1000 rupee, CST of 10%, 100 rupee, cost will become 1100. Now I am sitting in the second state. I will purchase it. I want to sell it to a customer because CST has gone to the state 1. I will not get ITC. I will include the 100 rupee CST. All right, so selling price will be 2100. Tax at 10%. Let's assume VAT. It will become 210. Final price will become 2310 rupees. Again, this is nothing new. Don't ask me, sir, what is CST? Why am I not getting CST? You are simply proving to me that you are not attentive earlier. I earlier took 100 rupee, now I'm taking 1000 rupee. That's it. Nothing else is the difference. Earlier I took 100 rupee and explained to you how CST will become or how CST will lead to cascading. Now I'm taking 1000 rupee. So pre-GST era, there was a cascading effect. Now look at GST era. Look at how GST will work. Interstate, interstate, one state to another state. Let's start. A will sell it to B from state 1 to state 2. A will sell it to B. Can I say IGST? Correct, interstate. Can I say IGST? So let's say IGST of 10%. IGST of 10%. That will become 100 rupee. So in the step number 1, government will collect the GST of 100 rupee. Now imagine I am B. I am selling it to customer. I am selling the product to customer now. So what I'll do, I will count it as 1000 rupee because I'm going to get ITC. I know that. So profit is another 1000. So selling price will be 2000. GST of 10% will be imposed 200 rupees. Selling price will become 2200. Now look at this calculation very carefully. Step number 1, government has collected 100 rupee IGST, that will be given to me. That will be credited back to me in the form of ITC. Step number 2, 200 rupee has been collected. It will be broken down into two equal parts. 100 rupee is a CGST, that will go to the central government, and 100 rupee, I've written wrong here, not state 3, but in fact state 2. 100 rupees SGST. So can I say, because the product has been consumed in the state 2, I repeat, because the product has been consumed in the state 2, this 100 rupee SGST will go to the government of state 2. Can we go forward here? All of you okay? Right? The center will get 100 rupee. Again, that is constant. Whether it is inter or intra, doesn't matter. Half of the money will go to center. That is fixed. Only contention is remaining half. That is SGST. Whether it will go to the state government 1 or whether it will go to the state government 2. It will go to the state government in which state good has been consumed. Good has been consumed, right? That is basically the idea. Okay, in this example, state 2 will get SGST of 100 rupee. So now please tell me, even in interstate, can I say GST can be used to abolish or basically to remove cascading effect? I'll repeat the statement. Even in under GST, even if the transaction is happening in interstate, we can use the GST structure to remove cascading effect, which was not happening earlier. Now under GST it is possible. Can we go forward now? Can we go forward now? Anybody has a problem? Are Baba. Right. What is the problem in taking examples? Right. Some of you are asking, why are you taking always 10%? My idea to make it easier for you to understand. To make it make it easier to understand. That's it. Sir, is it always 10%? You know the GST rates, right? 5%, 12%, 18%, etc. You know the rates. Rather than taking, let's say, 3% and making calculation difficult, I am giving you example assuming GST rate is 10%. Right? Again, I don't know. Okay, done. So at least now all of you okay when I say GST basically will help us in eliminating cascading effect, will help us in promoting ease of doing business, will promote manufacturing activities, will reduce the tax burden on the customer, etc. These are the benefits of having goods and services tax. Now last point, last point, after this we'll stop the discussion. I'm making a comparison between old taxation structure and GST structure. Making a comparison. Earlier, that is before GST, there were multiple indirect taxes. Central government had multiple indirect taxes. States also had multiple indirect taxes. Under GST, we will have only one tax. One tax. I'm not saying only one rate. I'm saying only one tax. Under the tax, we have multiple rates. 5, 12, 18 and 28. In fact, there is 0%, there is 1%, there is 5%, but that is very, very few, right? Few of the goods are covered under these. Most of the goods are covered under 5, 12, 18 and 28. Second one, different states earlier had a different tax rate. VAT for mobile phone was a different in many states. Mobile phone product is same, but VAT rate varied from one state to another state. Now, doesn't matter. Mobile phone GST rate is uniform throughout India. GST rate is only one. Okay. Earlier, national market was not possible. Now, under GST, national market is possible. Earlier, we had taxes on production. Now we have a destination-based taxes on consumption. Earlier, there was incidences of cascading. Now under GST, we want to eliminate cascading. Right? So that is basically the comparison between earlier GST method and the earlier taxation system and the current GST system. Okay, so this is a comparison. Today we'll stop the discussion here. Tomorrow we'll take it up. We'll continue the discussion. Couple of more concepts under GST and a couple of more ideas regarding overall taxation structure. After that, we'll take up questions. Okay. Now, what is the problem? Many of you are asking, what is national market? Arre Baba, very bad. I'm concerned about you people. Why? It's been hardly 45 minutes when I told you what is national market. Hardly 45 minutes. And now already after 45 minutes, after half an hour, you're asking me what is national market? What is CST? What is that? What is this? Right? My dear, you are supposed to remember this for 1 year. And you're not able to recollect in 30 minutes. I'm seriously concerned about some of the students. Seriously concerned. Okay, so national market means throughout the country, the tax rate will remain same. Throughout the country, tax rate will remain the same. Okay, that is national market. Okay, any questions? Any questions, please do let me know. Otherwise, we'll stop the discussion. VAT is origin-based tax, not destination. My dear, Government of India's documents say it is a destination-based tax. What is your source? You tell me. Government says it is a destination-based taxation. VAT is a destination. That is, whichever state where consumption happens will take the VAT. I gave you example also. State 1, state 2. In between state 1 and state 2, which state collected VAT? The state where consumption happened, state collected VAT. It is a destination. Check it. Check it. Okay. Okay. Is GST loss to state 1? My dear, not necessarily. I'm giving you one example and you're assuming only this will happen in India. Understand this. Some of you are asking under GST, if the good is produced in state 1, consumed in state 2, SGST will go to state 2. That's correct. SGST will go to state 2. Does it mean state 1 is always losing money? Not necessarily. Right? Tell me now, do you think whatever is produced in state 1, will it always be exported to other states? Does it make sense to you? Whatever is produced in state 1, is it always exported to state 2? No. Is it always exported to state 3? No. Consumption happens within the same state also. So some of the SGST on the product will be collected by state 1 as well. Second one example I told you, the good will move from state 1 to state 2, consumed in state 2. Can vice versa also happen for another good? Can the vice versa also happen for another good? That is, the good will be manufactured in state 2, but the consumption will happen in state 1. Which means in this second example, state 1 will collect SGST, not the state 2. So I hope you understand this. I gave you one example. Based on one example, do not generalize. Do not extend it as a universal example. Right? Just to make you easier, just to make you understand in an easier way, I took only one example. Right? But in fact, please understand this. The production states means the states where lot of goods and services are produced, such as Tamil Nadu, Karnataka, Maharashtra, Gujarat. If you see how much is the GST revenue collected by the states, very high, very high. In fact, the top 4 to 5 states will be these states only. Maharashtra, Karnataka, Tamil Nadu, Gujarat, right? These are production states. Lot of production happens. Doesn't mean whatever they produce, they will export it to UP. Whatever they produce, they'll export it to Bihar. No, that doesn't mean that. They are leading in terms of GST revenue collection. Okay. Sir, is GAR an alternative to the global minimum tax? Global minimum tax as of now, because global minimum tax has not yet come into force. GAR is applicable for domestic companies, domestic revenue. Global minimum corporate tax is applicable to multinational enterprises. Okay. Sir, where the GST money is required is the state where it produced or state where it is consumed, means I'm asking logically. Under GST, the state where the good is consumed, that state will get the SGST component. Can you frame question again that you said earlier regarding GST compensation? Statement 1, the central government or the union government has continued to collect GST compensation cess. Statement 2, this GST compensation cess is being used by the government to pay compensation for the states. Statement 1 is correct, statement 2 is wrong. Why? The government of India has stopped paying compensation to the states after June 2022 because the 5-year duration is over. Sir, so why now states are telling to expand the period of compensation? The argument that is being given by the states is uh, pandemic affected. Pandemic had a huge disruption in the economic activities. The states have suffered. Even today, the manufacturing activity, they say, is not recovered completely to pre-pandemic era. So, right, manufacturing activity, or let's say the production and sales is still subdued, is much lower compared to pre-GST. So their argument is, you told us GST will stabilize. You told us we'll be able to earn more revenues. That is not happening because of pandemic. So extend the compensation period. Who will credit this 100 rupee? Please tell in interstate trade. Is it center? My dear, please understand. It's not easy to understand all of this because some of the taxes are collected by the state government authorities. Some of them are collected by the central government authorities. Let's assume central government authority has collected. If 200 rupees collected by the central government authority, 100 they will give to central government and remaining 100 they will transfer it to state government. Sir, interstate, it's clear, but why there is no input tax credit in intrastate consumption? My dear, again I'll repeat it. Service tax is imposed and collected by the central government. VAT or sales tax is imposed and collected by the state government. Two different authorities. Do you understand? Two different authorities. So when you pay service tax to central government, state government, when they are collecting sales tax, they will not give you input tax credit. Why should they give you? Has the state government collected service tax from you? No, it has gone to the central government. That is the reason, right? The service tax that you have paid, it will become a cascading effect. It will lead to cascading effect. Sir, old VAT is origin based. Now it is a destination based according to Byju's website. No, as far as I am concerned, VAT is destination based. VAT is destination based. In fact, let me show it to you. UPSC had asked a question regarding this. Okay, have a look at this. UPSC had asked a question. Which one of the following is not a feature of VAT? I'll stop after this. I'll stop after this. I'll solve it. I'll stop after this. Which one of the following is not a feature of value added tax? I'll show you the answer directly. I'll show you the answer. Have a look at option D here. Please have a look at option D. It is basically a subject of central government and the state governments are only facilitator for its implementation. Last question to all of you. Please tell me, was VAT a subject of the state government or subject of central government? Let me know. Is VAT subject of the state government, subject of the central government? And some of you, I'm actually surprised by answers of some of you. Sir, it was the subject of central government. My dear, then you're not listening. You're not listening. You are not attentive in the classroom. Why? We have discussed this. Did I not say, right, in the GST, before GST, introducing GST, did I not tell you earlier state government had sales taxes? To address this particular sales tax, state governments introduced VAT system. Then I told you, despite having VAT system in the states, to address issue of cascading effect, because of interstate sales, There was a cascading effect. All of this is done. It is a subject of state government. So statement B is wrong. Now look at various options. Look at various options. It is a multi-point destination-based system of taxation. Statement A is correct. It is a tax levied on value addition. Statement B is correct. It is a tax on final consumption of goods and services and will be borne by the customer. Statement is correct. So it is a destination based system of taxation. Destination system of taxation. Okay, so that's it from my side. Today we'll stop. Tomorrow we'll take up remaining questions. Don't worry, right? Because the student was repeatedly asking, it is no, it is right, origin based, etc. And again, please understand, whether any tax is a destination or origin based, it is not based on the name of a tax. It is not based on the name of a tax. It is based on how the taxes are imposed, collected, and who will use it. Last point, I'll stop after this. Whether a tax is a destination or origin, name doesn't determine it. Name doesn't determine it. How it is imposed, how it is collected, who will use it, that will determine whether it is a origin, whether it is a destination. All right, so that is a basic idea. For example, let's say in the future, I'm not saying this is happening. Let's say in the future, if the government of India will say the SGST component will go to the state where production happens. Is it okay? I'll repeat the statement. It is not happening, but if I say in the future, government of India says the SGST component will go to the state where production happens, then can I simply say in that case GST will become origin based taxation? Right? Anybody has a problem? If government will change the policy and say SGST will go to the state where production will happen, then automatically GST will not become destination, it will become origin based. So again, reiterating the same point, names doesn't determine. Name doesn't determine what is this tax, right? What determines it? How it is imposed, who will collect it, who will use it. That will determine whether this is origin or destination. Okay, so that's it from my side. One more slide is left out before this. That is, why do we have multiple rates of GST? Why do we have multiple rates? Tomorrow we'll continue from this slide. Tomorrow we'll start from this slide. Okay, so take care. That's it for today. Let's meet tomorrow sharp at 6 a.m. By the way, I've given you a list of articles from Hindu newspaper today. Please read those articles. You might not understand some of them. Don't worry. Do not panic. Read all these articles. Okay, so that's it from my side. Take care. See you tomorrow.